All right. Well, my name is Dr. Rebecca Mears. I'm a member of the VIN Foundation student team. Really excited to get started here with you all with the Interns and Residents Repay Wiser webinar. Thanks for joining us. This has been brought to you by VIN Foundation and VIN students. I'm going to do a couple of housekeeping things, and then we'll get it turned over to our presenter, Dr. Tony Bartels. Seems like most people have found the chat. You can make sure that you change your settings to everyone and off of hosts and panelists. Keep an eye on that chat window for information and shared resources. You can share any technical issues that you have throughout the session there, but we do try to keep that clear of questions. Instead, I'll direct you towards the Q&A. You can also find that button down at the bottom. It'll open up another window for you. So use that Q&A for any questions that you have. You are able to ask questions anonymously if you prefer. One of the great things that you can do there is upvote or thumbs up those questions so that we're able to see which are sort of the most pressing questions the most people are interested in. We will be answering questions live throughout the presentation, and then there will also be time at the end that we'll answer more questions as well. We will be getting through all of those before we finish up for the night, so just make sure that you drop your questions there in the Q&A and leave that chat free for some of the other conversations that we're going to have. There's no stupid questions, so make sure to drop your question there if there's anything that you're wondering. If we don't get your question as soon as you ask it, don't worry, we'll be getting through all of those. We will have a recording that'll be sent out in the next couple of days. So if something happens and you lose your internet connection or anything, don't stress out. This recording will be sent out in the next couple of days along with a PDF checklist. That email will be from studentdebt@vinfoundation.org. So make sure to pay attention to that. We've got a couple of people joining us here in the background. We have Jordan Benchia and Charnette Lewis from VIN Foundation. So we're really excited to have them. They're going to be helping to answer some of your questions. And I'm going to go ahead and turn it over to Dr. Tony Bartels and get us started off here.
Thank you, Becca. Thank you for getting us started, and thanks to everybody who's posting their locations in the chat window and everybody who completed their signalment form submission. Thank you very much for that. It really helps to know some of the challenges that we're dealing with for the attendees tonight, and generally get to see a good slice of questions, concerns, scenarios from everywhere between veterinary student and in the midst of residency training. So super helpful to see those, and it helps to update the content for these sessions too, so it's more relevant for sessions like this evening. I do have one poll for you tonight that will just kind of help me understand who's here, right? So so we can also make sure that we touch on various topics. Cool. And if you, I believe you have the ability to, if you're comfortable and you chose the other selection, if you don't mind putting that either in the chat or somewhere that we can see, just so so we know a little bit more about you, since that seems to be a little higher percentage. Okay, PhD student, very cool. Pre-veterinary, wow, how did you find your way in here? Definitely very cool. Really trying to get a jump on things. New grad, veterinarian. So new grad, if you're hopefully a new grad, if you're heading into an internship or you're planning on doing a residency, or you're heading directly into a residency, that's going to be kind of the content that's going to be the focus of this webinar this evening. Cool. So I'll share these results with you. So a good slice here. Great to see. Amazing. Thank you to the interns and residents. I know your schedules are generally crazy. So, thank you for penciling some time in for this tonight, and hopefully we can answer your student loan questions as we make our way through the presentation this evening. All right, so let's dive in. A lot of content to cover. I did pepper in a lot of the primary concerns and some of the questions that I read in the signalment form submissions. I'm also going to go through some of the logistics of how you can do this annual physical exam that we're going to talk about on your student loans. So hopefully it's not going to occupy too much of your time. You can understand what you're looking at. We can get beyond kind of the analysis paralysis that involves most veterinarians in dealing with their student loans. So you don't have to spend a lot of time on this, but you want to be able to identify things that we cover tonight so you can either make sure you're on the right track or switch gears quickly and early to try to get back on track as quickly as possible. In the Signum form submissions, I saw a lot of not having the student aid data file that we asked you for. And I'll show you, I get it, sometimes you're not really sure why we asked for that kind of information, or maybe you didn't even know where to find it, but that we want to make sure that you know where to find that information, why we asked for it, how we can use it to do a physical exam and understand your student loans. I also want to make sure you guys are familiar with how the student debt message board folder works, right? So that's where we provide personalized assistance. And some of you alluded to that in your Signum form submissions, that you would like some personalized assistance, but you didn't necessarily check the box that said, I'd like to see my case posted anonymously on the student debt message board. And that's how we do that. So we'll make sure that we cover all of those things so everybody's on the same page in terms of how do I do a physical exam of my student loans, and how can I get help if I feel like I have some additional questions that are, outside the scope of the group setting that we'll be covering this material in tonight. So ideally, before this session ends, we want everybody to be able to do a physical exam on their student loans. You're going to need to do that at least annually, or when your circumstances appreciably change, right? So just like we ask our veterinary patients to do, at least an annual physical exam to make sure that everything is as expected, right? And you'll be amazed at how many times that you'll find things that you might not expect, or at least I'm amazed. So from that physical exam, from the diagnostics that we'll do using the tools on vinfoundation.org and the Student Debt Center, we'll be able to create some treatment plans to help you navigate your student loans and make sure that you're providing yourself the maximum flexibility and ideally reducing the total cost that you're going to pay towards your student loans, and give you some ways to reduce your risk if you're not really sure how your career is going to unfold, or you just want to have some more flexibility and leave yourself some options open. Side effects definitely are going to be plentiful. Regardless of how you choose to pay back your student loans, there's going to be side effects, right? So whether you want to pay them back as fast as possible, or you want to use an income-driven plan, or you've heard some things about forgiveness or public service loan forgiveness, I mean, all of those things are going to have side effects with it, right? So every action is going to have a reaction, right? We just want to make sure we know what some of those reactions are, particularly if they're negative, so we can, again, identify them quickly, manage them, reduce the risk to our cash flow or our loan repayment strategy, and then move on to practicing veterinary medicine. Prognosis, we'll go through, good, regardless of how high your student debt balance might be or how stressed you are about your student loans. As long as you have the tools and know how to handle them, I think you can manage pretty much any amount of student debt that you may have. And it varies quite a bit. From the Signum form submissions, I mean, there were people that submitted $30,000 of student loans, and there were people who submitted more than $600,000 of student loans, right? So obviously, depending on where you fall on that spectrum, is going to have a very different treatment plan. But that's why we're doing these, right? We want to make sure that everybody knows how to best handle their student loans, no matter where you fall on that particular spectrum. Then we'll finish up hopefully with some financial wellness items. And while you're navigating an internship and residency, I consider those timeframes to be financial damage control, really, right? You're really not earning all that much. Although there are some internships and residencies that are paying quite a bit more these days, the overall average is still pretty minimal, right? So just making sure that you're able to cover your basic living expenses and not take on any additional credit card debt is really the goal when you're navigating an internship and residency. All right, so why do you want to do this as early as possible, ideally, right? So I'm excited to see those of you that are students and maybe just graduating right into starting your internship, or maybe you haven't started your internship but will in maybe a week or so, or you're just starting your residency, right? These are the prime times to really take control of your student loan repayment strategy, because as I'm kind of joking here, you probably don't have a time machine, and you're not going to be able to go back and undo some of the things that we're going to talk about tonight, right? So the sooner that you can get these things established and in place, the easier it is to sleep soundly when it comes to your student loans, right? So making sure that you're aware of what can happen, what should happen with your student loans as you're navigating this internship residency pathway. So you're minimizing the damage that can happen from your student loans. Now, there are some recent announcements that have been made that kind of give you a bit of a time machine, right? But not a full one. I mean, if you've, like just an example, I actually have a case that we'll run through tonight using the Student Debt Center tools. I mean, if you're a third-year resident and you've had your loans in deferment for this entire time, there's not much I can do about that, right? You're not going to be able to go back and undo that, right? But if you're just starting your internship or you're just starting your residency and maybe you've had your loans in deferment for a year, we can talk about why you need to end that and get your loans into a repayment plan instead, right? So that's where the timing of this is critical. One of the one of the cases we're going to go through pertains to this, right? Annoyed, and this is a common sentiment. I saw some of this in the Signalman Forum submissions as well. Annoyed that I borrowed $180,000 for school. Internship residency salaries have made it so now I owe $270,000 as I'm finally starting a real job, right? So this is a perfect example of the time machine, right? Not having the time machine. This is not normal, right? 180K. It can be possible for your loans to be higher after you finish your residency training, but not that much higher, right? So something was wrong there, right? And we want to show you what that is so you can avoid that and not have that happen to you. This person, though, also has 5 years of public service loan forgiveness credit, right? Which is pretty cool. Not all internships or residencies are going to be eligible for that, although I think they should be. If you can prove to your coordinator that they should sign the public service loan forgiveness employment certification form, then you might get credit as well. But that's also going to interject some interesting decisions, right? Should you continue on and maybe a career path you didn't see yourself doing, or so you can, complete the public service loan forgiveness pathway, or maybe you're going to, pursue private practice and move away from public service loan forgiveness, right? So these are all things that you all are going to be facing or are facing now when it comes to, finishing off or navigating your student loan repayment strategy. So ultimately, we want to reduce our student loan stress and improve your loan repayment success. I'm going to give you a little bit of a background. I asked you guys for your student loan history and Signalman. I'm going to give you some of mine. So I'm a married 2-vet household. We do have a new baby girl. We just welcomed about 6 weeks ago. Her name is Lucy. This is her down here in the bottom right. This is one of our Labradoodles, Maggie, who has kind of claimed unofficial motherhood over her. So she is never more than about 6 or 8 inches away from her. So pretty interesting to see the dynamic between the doggies and the baby. I'm looking a little bit more forward to the interactive phase of the new human in the house, but so far so good. But as we'll cover too, family sizes, your marital status, all of these things play an integral role into your student loan repayment strategy. So now we are a family size of 3. We happen to file our taxes jointly in this household. We both have student debt. Based on the repayment plans that we're eligible for, that makes sense for us, right? But there can be various scenarios where if you're married, it may make sense for you to file your taxes separately from your spouse. But either way, you'll be able to count any children, unfortunately not any pets, in your family size when it comes to calculating your student loan payment if you're using something like an income-driven repayment plan. So both of us are veterinarians. My wife went the specialty route, so we got to learn a lot about what to do and what not to do during her internship, fellowship, residency training. I went more to the GP route, did a combined MBA DVM at Colorado State, but in total, we have more than $400,000 of student debt. We manage those using income-driven repayment plans, right? So some of you, if you've had some version of this as a student, or you've heard me talk about this before, income-driven repayment plans are specific repayment plans that are available for federal U.S. student loans. They can be extremely helpful, particularly for most new graduate veterinarian scenarios, and especially internship, residency, advanced training scenarios, right? So as many of you are, you're not probably going to learn this, or maybe some of you will if you're a new grad. If you do nothing with your student loans after your grace period ends, they'll put you in what's called the standard 10-year plan. So they basically take your principal, your interest rate, and they calculate what the monthly payment needs to be to pay the balance off in 10 years, right? So at $400,000 of student loan balance, that would have been a $4,500 a month payment under the standard 10-year plan, which was more than we were earning. So there was no way we could do that even if we wanted to, right? So we started using these income-driven repayment plans. IBR was an earlier version of that. As the name implies, the income is an integral factor in calculating the monthly payment. So that got us down to $1,400 a month. We have since switched to a new version of income-driven repayment. Well, it's not so new anymore. It came online in 2015, but it's called revised pay-as-you-earn, right? So we crunched the numbers. It made sense mathematically for us to switch from IBR to repay. Our payment is lower as a household. And that has really helped us to have a financial wellness strategy that involves something other than paying down our student loans, right? And with the pandemic forbearance benefits that anybody with federal student loans have been experiencing for the better part of 2 years, or a little bit more than 2 years now, there's no interest accruing, there's no payment due, but the time that we are spending in repayment is eligible for forgiveness credit. Right. So as we'll talk about when we get to the details of the income-driven repayment plans, you make payments based on your income for a specific period of time. And if you still have a balance remaining at the end of that maximum repayment period, then that remaining balance is forgiven tax-free. So for example, revised pay-as-you-earn, the plan my wife and I are using, has a maximum repayment period of 25 years. We've been in repayment for a little more than 10 years. So we have 15 years left where we'll either pay our balance to zero or we won't, and there'll still be a balance remaining, and whatever that remaining balance is will be forgiven. But we may also have to pay tax on what that forgiven balance is. The nice thing about the pandemic forbearance benefits is that even though the interest hasn't been accruing and no payment has been due, that 2+ years still counts towards forgiveness, right? So it hasn't extended the amount of time that we'll be in repayment. It's actually kind of shortened the amount, or not really shortened, it decreased the amount that we'll pay towards our student loans in total, which has been extremely financially beneficial for those of us that are using these income-driven repayment strategies. So we're not currently making a payment because not a payment's due because we're planning on hitting forgiveness. We do fund our forgiveness plan, right? So our projected amount that we think we're going to have to pay in taxes 15 years from now, I am funding a separate combination of investments to help us reach that target. And we're about 70% to that targeted goal with 15 years before we would have to pay the tax, which means we're ahead of schedule, right? So I fully plan to be at 100% here, hopefully in the next 5 years, which means we can either stop contributing to that forgiveness plan or kind of redirect those funds if need be. But it also gives us some time to adjust or readjust if we, find out we need to pay more in taxes, or maybe we will find out we don't have to pay anything in taxes, right? So it's all meant to hopefully over prepare for what could be a tax or maybe a non-tax at all. So this is a snapshot of my forgiveness plan, and the bulk of our forgiveness plan, I invest in a platform called Wealthfront. It's a robo-advisor. It's one of these platforms, and there's dozens of them out there, right? So Wealthfront, it just happens to be the one that I choose to use. Betterment is another example of that. Ellevest is another example. Vanguard, Schwab have their examples of this, but they're essentially computer algorithms, right? And you tell them what you want your investment risk tolerance to be. So on a scale of 1 to 10, 1 being super conservative, 10 being let's roll the dice and I'm just going to be happy with whatever the stock market does. I have ours allocated somewhere between a 7 and 8, so fairly aggressive, right? So the dotted line is what we contribute. The solid line is the value of that fund, right? So a lot of the appreciation is the value of this investment is not money that came out of our pocket, right? It's due to the compound investing, the reinvestment of the dividends in here, the appreciation of the value of the fund itself. All of those help to reduce the total cost that we'll end up paying if we end up having to pay a tax, right? So this is just an example of what this looks like. I'm averaging somewhere around, I would say a 10% return per year, but you can see that an average is that's if I took this dot and this dot and average it over the 7-year time frame that we've been using this, right? But you can see there's a lot more variance in there, right? So there was periods where the value of this fund was actually below what we contributed, right? This was the pandemic when it started, when we shut down the economy, right? But you can see that it also rebounded, right? So, and over long periods of time, if you look at anything involving, the stock market, retirement investing, those types of things, you'll see that this trend is pretty persistent, right? So as long as you're willing to kind of stomach that up and down, you can benefit from the power of compound interest and the general trend of American companies to increase in value over time. So sorry. All right, so now here we're going to show you exactly how you can find your student aid data file so you can do that physical exam on your student loans. All right, so I'm going to take you guys over to studentaid.gov. Right, so this is kind of the federal student dashboard, student aid dashboard, if you will. If you are applying for loans, you'll be very familiar with this. If you've applied for a consolidation loan, you'll be very familiar with this. If you've been applying or providing your income documentation for an income-driven plan, you'll be very familiar with this, right? So you can log in here. Everybody that has U.S. student loans has this type of account, right? So I'm going to log in. You guys get to see the share of my student debt balance of the household. But it's just here to illustrate how you can find the student aid data file and make sense of some of the information in here. So you'll see here, I've got $170,000 of total student loans, $163,000 is principal, $7,700 is interest, right? This is something we're going to talk about later. But if you're using an income-driven plan, right, or even during your internship or residency, if you're making payments on your student loans and that payment is below the interest that would normally accrue, you will accrue interest, right? If you're using deferment, forbearance, you'll accrue interest, right? But the key is to try to keep this interest off the principal, right? Because if the interest gets added to the principal, then you'll accrue more interest over time. The more interest you accrue, the more you're going to pay towards your student loans, right? So we want to make sure that we're doing things with our student loans that prevent this interest from getting added to this principal, right? And that's probably one of the most common mistakes I see veterinarians make with their student loans, right? Is there's a lot of adding of interest to the principal, and there really shouldn't be if you're doing this correctly, right? So that's not really why we're in here. It's helpful to illustrate that and plant that seed for when we talk about that later. But I'm really gonna, what I'm looking for is my student aid data file. It's not on this dashboard. I'm gonna hit the view details link here. Right, and in here, I'm gonna see the My Aid summary, download My Aid data. That's what you're looking for, right? And you have to do this on some kind of device that allows you to save a file, right? Because this is gonna be an ugly looking text file that you're gonna download to your computer, right? And iPhones generally don't like to download files from the internet, right? So you're gonna have to do this on something that has a screen resolution that's wide enough to show this download My Aid data and allows you to save files to it, right? So click that link and you can save, it's a .txt or a text file, right? You want to save it in that text file format, and I'll show you in just a minute here what you can do with that file. All right, a couple of questions I see in here. I might as well answer these here while we're kind of just covered these. So Amanda asked, my understanding is that the forgiven amount is taxed as income tax. So we'll probably change your tax bracket the year it is forgiven. Is that correct? Potentially, right? So right now there is a exemption on any student loan forgiveness, right? And that means that any amount that's forgiven, any amount of student debt that is forgiven is exempt from being treated as taxable income, right? Now that special exemption is only good through 2025. Right. So anybody that experiences student loan forgiveness between 2021 and 2025 will not have to pay tax, regardless of whether or not they're working in public service or they're just using an income-driven repayment plan, or they benefit from some of the expanded announcements that we've learned recently. Right. So right now, there is no tax on student loan forgiveness. Generally speaking, any debt that is forgiven can be treated as taxable income. Right. So depending on what Congress does with that special exemption on student loan forgiveness through 2025, if they extend it, then again, depending on how far into the future they extend it, we may not have to pay tax on our student loan forgiveness, depending on when we have our student loans forgiveness. So I mentioned my wife and I wouldn't receive or be eligible for student loan forgiveness for another 15 years, right? So 2037. So 2037 is currently outside of the tax exempt window for student loan forgiveness, right? So that's why we're planning as if we do have to pay the tax. Now, if we do have to pay the tax, you're absolutely correct that the amount that's forgiven can bump us into a higher tax bracket, right? But that's okay. I mean, it's, the highest federal income tax bracket right now is 37%, right? So the highest tax bracket we could possibly be in is 37%, which means we would get a 63% discount on whatever's forgiven, right? So yes, I want to be aware of the tax brackets, what they're doing, especially as I'm approaching forgiveness and whether or not that forgiven amount might be treated as taxable income. But I also want to be cognizant of the fact that tax rates are relatively low, right? It probably doesn't feel that way when you get your paycheck, right? But tax rates are relatively low, right? So if I'm going to hit forgiveness, I want to take full advantage of the fact that I'm only going to have to pay at worst, potentially at 37 cents on the dollar for what's remaining, right? So yes, you do have to be aware that you potentially might get pushed into a higher tax bracket if you live in a state that has a high income tax, like maybe California, New Jersey, Illinois, right? New York, right? You may have to pay state tax on that as well, right? But still, we're not looking at paying, any more than, at worst case scenario, maybe 50% of what's forgiven, right? So yeah, definitely something to be aware of, but certainly not something to be afraid of. Another question, do you contribute those investments that you are using to pay the tax at forgiveness monthly? That's one of the things, that's a great question. I actually contribute to Wealthfront weekly. And that's one of the reasons why I like it and I use it, is because it's one of the only robo-advisor platforms currently that allows you to make contributions weekly or as soon as possible. There are some other ones like Robinhood lets you do it daily, right? But that's a little bit of a different platform in my opinion. So the Wealthfront one, I like, how they have it configured, how they provide the tax documents that I need. And also there's some tax loss harvesting and things that go beyond the scope of what we're going to cover tonight. But I do like the fact that they allow me to contribute weekly to my forgiveness planning fund, which I find helps to increase your overall returns on a long-term basis. The more frequently you can contribute, the better return you tend to have, right? Because, if you watch anything involving the stock market, you know that it could swing wildly from day to day. So the sooner you can get those contributions into those accounts, the more that flattens out that variance. But the trend generally is upward. So I do appreciate that I'm able to contribute to that fund weekly, which is one of the main things that I like about the Wealthfront platform. But great question. All right, so in the physical exam, what are we looking for, right? So I want to see what loan types I have. There's been a lot of changes over the last several decades when it comes to how we fund higher education, right? And you as the borrower, depending on your pathway to and through veterinary medicine, are going to see those changes manifest differently depending on when you started college, right? So we have to know what kind of loan types we have, because different loan types are eligible for different types of repayment plans. Obviously, we want to know the amount. That helps us to know exactly what's going to happen in the short term and the long term. The interest rates, they're fixed for most federal student loans. Way back in the day, they were variable, but most of them are fixed. So we want to know what those interest rates are so we know how much interest we're accruing. Repayment plans, depending on what we've been using, what we're currently using, what might be better for us to use depending on what we find in our physical exam. The minimum monthly payments, this is a huge one because, again, they've been turned off. But if you've been making payments prior to the pandemic forbearance period, you want to know what that minimum payment was and what it's going to be and for how long until you might have to provide income documentation again, right? All of that stuff is going to be visible in your student aid data file. So we're going to find a variety of different loan types in there. So direct loans, those are going to be the primary one that most of you are going to see, but some of you might have federal family education loans if you were in higher education before 2010. Perkins loans, I still see floating around for a lot of veterinarians. Health profession student loans and loans for disadvantaged students. If you went to a state veterinary school, I see those quite frequently. And then private loans are going to be anything that doesn't fall into that category, right? So your private loans will not be in that student aid file that live on studentaid.gov. You can find them on your credit report, right? So annualcreditreport.com. great habit to get into checking your credit report at least annually. You can do that for free at least once a year, right? But during the pandemic, they've been letting you check it weekly. But annualcreditreport.com, that's where you can find your credit report, right? Not your credit score, but your credit report, which basically shows you all of your open lines of credit, right? So any loans that you have in your name, student loans, private loans, home mortgage, auto loan, those sorts of things. You know, if you were ever delinquent on a utility bill or something, it'll show up on your credit report if you're reported, right? So those are the types of things that you're looking for, so you know what's on there, have a sense of what your credit worthiness is, and if you lost track of anything, so you can correct that. That's also where you'll find evidence of identity theft, right? If somebody got a hold of your social security number and opened a credit card in your name, you'll see it on your credit report, right? Because your credit report is basically tied to your name and your social security number. All right, so here's where we're going to use that student aid data file, right? So we're going to upload that student aid data file. We're going to go over to the Student Debt Center, which is a free tool, right? And we're going to focus on the My Student Loans tool to start. So the Student Debt Center, anybody can use this, right? It's designed specifically for veterinary students and veterinarians, but it's publicly available, right? And everybody does use this. I see files in here from chiropractors and dentists and physicians and lawyers and undergrads, but it's designed specifically for veterinarians and veterinary students. So make sure that you're taking advantage of it. We're going to want to focus on the My Student Loans tab here, right? You'll see here that if you have VIN or VIN Foundation username and password, you can log in and use that, right? You'll have some special features that you can access. So I'm going to log in with my VIN credentials here to show you what those look like, right? But you don't need VIN username and password to use this, but I highly encourage that you're logged in while you're using it, right? You can see that I've got a little bit of activity here, but it will save your files that you upload in here, right? And it'll also provide you access to the student debt message board area, which is where we provide personalized assistance. Right, and I'll come back to that later, but this will show you that direct link to the student debt message board area where you can post anonymously and get specific help that's related to your circumstances. But here, I'm just going to show you one of the cases I have tonight. I have graduated from veterinary school. That's the one that we're going to focus on. If you're still in veterinary school and you have some borrowing left to go, then you want to use this middle box. For the pre-veterinary student, if you haven't borrowed yet, then you may start here. Right, that's more that if you want to see how student loans are dispersed and all that sort of thing during veterinary school. But I'm going to upload here, focus on that one. I've got some cases here. This is the one that I want to show you as kind of a subtle reminder of what necessarily not to do, but it also does a great job of illustrating all of what can be in here. Right, so this is a person who graduated, 5 years ago or so, did an internship and residency pathway, and is now finishing that residency training and is going to be working as a specialty equine practitioner. Right, but this will help to illustrate what we can see in your student aid data file. Right, so by itself, if you open up that text file, it's going to make your eyes blur over. Right, but we pull out the relevant information to help you do that physical exam and make some decisions on your student loan. So I can see that I've got 14 loans here, $238,000 of principal, $32,000 of unpaid interest. We talked about that when I showed you my file, or when I was logged into studentaid.gov. The total owed is $270,000. The interest rates are shut off, right, because of the pandemic forbearance period, not accruing any interest. They did have a monthly payment of $116,000, presumably before the pandemic forbearance period started. So that's where I'm going to start going down here and looking at some of the different loan types. So I see here that I've got direct loans, or 12 of the 14. I've got these older FEL program loans that I'd mentioned. There's 2 of them. So this person started their higher education career before 2010 and have these FEL program loans. So here, 2008 is when they received that. You want to know if you have these FEL program loans, right? Because they're kind of the old school ones and they're not nearly as beneficial as the direct loans. So look to see if you have those FEL program loans, particularly if you were in college 2010 or earlier. The direct loans, I can see here, most of them are listed as being in pay-as-you-earn, right? So PAYE, that's a type of income-driven repayment option. We can see here, FEL program loans are listed as being in IBR 2009. right? That's our first clue that there's something different about these FFEL program loans, right? They're not eligible for pay as you earn, right? They're only eligible for the older version of IBR, right? So you can have different loan types in different repayment plans depending on the loan types that you have, right? So that's just the first thing I notice in here. Loan types, there's going to be a bunch of different types here, but again, the direct loan is the one that I'm really concerned with. I can see the FFEL program loans that are in here. I see my loan servicer. This is really important if you have FFEL program loans, right? If you have FFEL program loans, I want to see if it says Department of Ed in the name, right? Because that means that they're a federally held version, right? And there are some nuances for the ones that aren't federally held that apply to some of the recent announcements, right? So that only matters if you have some of those older FFEL program loan types. So if you're doing this while we're talking about it, right, upload your file into the My Student Loans tool and see if you notice any FFEL program loans. And if you do, this is a great time to ask questions about them, right? Because those are the source of a lot of the issues that we see reported around, why is nobody qualifying for public service loan forgiveness? And how come nobody's received any student loan forgiveness? A lot of that has to do with the FFEL program loans, right? And them being kind of outside of the qualifications for a lot of the newer, more beneficial repayment programs. But a lot of people had those FFEL program loans and didn't know that they needed to switch them into some other loan type to make them eligible. Right. So that has to do with a lot of the nonsense that we've been hearing and reporting when it comes to student loan repayment and all of the horror stories. Probably the most important tool in here is the income driven repayment eligibility tab. Right. So here we'd see that we're eligible for IBR 2009. We know those FFEL program loans are using that plan, pay as you earn, right? Not 100% are using that because those FFEL program loans are not eligible for pay as you earn. However, if this person were to consolidate those loans, they would be eligible for pay as you earn, all of them, 100%, right? Revised pay as you earn, that's the plan my wife and I are using. So my wife and I don't use pay as you earn because we're not eligible for it, right? And pay as you earn has some goofy eligibility requirements, but generally speaking is one of the most beneficial repayment plans in the whole federal student system. Right now, there are some instances where revised pay as you earn can be more beneficial, particularly if you aren't eligible for pay as you earn. But for some of you, particularly those of you that are in residencies that could have you making, in the high six figures when you're certified, when you're board certified and done, and now your income exceeds your debt, revised pay as you earn can sometimes be a better choice than pay as you earn if you have the option between the two. But we'll spend more time later talking about how you can make that decision for yourself. But I want to first see what are my loan types that I have, which repayment plans are they eligible for, particularly is this person eligible for pay as you earn and are they using it, right? Because if they're not, then there probably should be a really good reason for that, right? And we'll talk about what some of those reasons are. This person,
Tony, we actually have a question in the Q&A right now that kind of
Sure.
relates to where you are here. Health profession loans aren't included in our aid data with our federal loans, adding those, and then also how do we pay those? Do we have to pay those off separately?
Yeah, so great question. Health profession student loans are not in your student aid data file. So thanks for that reminder that you will not find them in there, but they are, and same for loans for disadvantaged students. You won't find them in your student aid data file, but they are a type of federal student loan that you can make eligible for these income driven repayment plans, right? So if you want to kind of account for them as part of your student loan physical exam, you can add them in here. These are the loans, these are the only loan types that you can add to the My Student Loans tool, right? Because again, the My Student Loans tool is predominantly concerned with federal student loans and the federal student loan repayment options. So if you have any health profession student loan balance, add it in here, right? So let's say you've got $15,000 of health profession student loans, right? And the servicer might be the school, right? But oftentimes after you graduate, the school will transfer those loans to a different servicer. So like Heartland ECSI is one of the major national servicers that your school may transfer those health profession or loans for disadvantaged students loans to that Heartland or ECSI loan servicer, right? That's not particularly that important unless you're just looking for it, or maybe that triggers some, oh, I've been getting some emails from Heartland recently and I didn't think they were a real thing, right? But they are, right? So if you do have those health profession student loans, you can add them here and we'll account for them in your total. We'll add them in your groupings. And when you see the income driven repayment eligibility, you'll see the percentages change too. And that's because health profession student loans by themselves are not eligible for an income driven repayment plan. But if you have them, you can consolidate them. You can include them in a direct consolidation loan and make them eligible for the income driven plans that you are eligible for, right? If you don't consolidate them, then yes, you have to pay them separately, right? And you can only pay your health profession student loans using a standard 10-year plan schedule. Right now, if you're doing an internship or residency, you can postpone those. You don't have to make payments during that internship or residency. And health profession student loans, loans for disadvantaged students, actually will allow you to defer them with no interest accrual during that advanced training. However, if it looks like you may be on a forgiveness track, right, whether that's public service loan forgiveness or you're going to hit forgiveness, maybe have to pay a tax, maybe not, you'll want to include those health profession student loans in your direct consolidation because that's the only way to make them eligible for any of the forgiveness plans, right? So we did a webinar a month ago or so specifically for new grads, right? And when we do that webinar, we encourage you to graduate, consolidate, get started into an income-driven repayment plan. If you're a new grad, follow that playbook, right? Or go visit it, right? You really want to get all of those federal loans consolidated and into the most beneficial income-driven repayment plan so you can start that forgiveness eligibility across all of your loans as soon as you possibly can, right? Because it gets really messy the farther you go down the road. You know, you're 4 or 5 years in repayment, you just realize you've got $25,000 of health profession student loans and you're finishing up your residency, but you're going to go work in academia. Well, you could have gotten potentially, 4 or 5 years of public service loan forgiveness qualifying time on that health profession student loan if you had consolidated them. But it's too late at that point. You can still consolidate them, but now you're going to be on a different forgiveness clock than the rest of your student loans. So if you want to keep this as simple as possible and make everything qualify and be eligible for the same repayment plans at the same time, then you want to consolidate your loans as soon as you can after graduation. All right, so kind of working through our physical exam here. I'm going to take these out just to, that was just for example purposes, but if you do have those loan types, you can add those in, you can remove them, right? And if you're logged in, right, when you pull that file up, it'll actually keep those loans attached to the file that you uploaded previously, right? So you only have to do that once. Monthly payment, $116, right? That was their payment during their residency. One of the other things that's really important for those of you that were in repayment as the pandemic forbearance periods took effect, right? So one of the things I really want you to pay attention to is the anniversary date, right? So when you use an income-driven repayment plan, you have to provide income documentation at least annually, right? And your anniversary date is unique to the income-driven repayment plans, right? So if you upload your file, you'll only have an anniversary date if you're using an income-driven plan like pay-as-you-earn, revised pay-as-you-earn, income-based repayment. Here we see that this person isn't due to renew until 2024, right? And that is a direct effect of the pandemic forbearance benefits. Right now, some of you are going to see anniversary dates that may have even passed or are coming up in maybe a month or two, right? But nobody has to provide any annual documentation as part of the pandemic forbearance benefits until at least March of 2023, right? And if your anniversary date, it's in your file, is between now and March of 2023, then you can add a year to it, right? Because it'll eventually get updated to reflect that announcement that was made when they recently extended the pandemic forbearance benefit. Right, so even if the pandemic forbearance benefit ends at the end of August, as it's scheduled to do, your recertification date may not be until well into the future. And for those of you that are currently in an internship or residency, your payment is probably very, very low, which means you'll be able to continue that payment for a long time yet, based on the pandemic forbearance benefits, right? So pay real close attention to that anniversary date and what your current monthly payment is, right? And unless your income has decreased, There's no reason for you to interrupt that, right? Let that payment continue to be low, right? Now this person's graduating. They're going to start as an equine specialist earning $125,000. Their monthly payment is $108 per month for another year and a half. Let it be that, right? Take advantage of that flexibility so you can jumpstart your financial wellness rather than paying more than you have to towards your student loans, right? But that's a huge benefit, right? So look at that anniversary date, know what that is for you, and take advantage of any additional time where you have payments that might be very, very low. For some of you, your payments are probably zero, right? And that could continue for a year and a half or more, right? Take advantage of that, right? Hugely beneficial. This person also has some public service loan forgiveness eligibility time, right? So this does prove that some residencies can earn public service loan forgiveness qualification time, right? This is in your file, right? If you're doing this correctly, right? And there's some links down here. If you're submitting a public service loan forgiveness employment certification form as you're navigating an academic internship or residency, they will start tracking your public service loan forgiveness progress in your file. Now, this person told me that they have 5 years of public service loan forgiveness credit. Probably not that much, right? They have at least 2 years. My guess is they're not counting for the 2+ years yet that we've been in public service. That we've been in the pandemic forbearance. They haven't really accounted or added that to the files yet. So that'll probably add at least another, 28 months or wherever we are now in that schedule, but it probably won't quite get to 5 years. Right. But, maybe if I'm wrong there, maybe they just need to go back to wherever they did their internship and see if they can get credit for that particular time as well. This will tell you whether or not you have any time documented in your file. This says inconsistent amounts because we've got this FEL program loan that technically is not eligible for public service loan forgiveness. Right. So another reason why you want to identify these so you can consolidate them and make them eligible for public service loan forgiveness. Now, there's some really, really cool and special announcements that have been made in the last year or so that will allow you to consolidate these loans, but still receive retroactive public service loan forgiveness credit for loans that otherwise would not have been eligible for public service loan forgiveness. But you have to do that in a timely manner, right? Consolidate those before the end of the year, and then you resubmit the employment certification form, and then you'll get that past forgiveness qualifying credit. Right. So there's a lot of really confusing things about student loans, but overall, they're extremely beneficial if you spend a little bit of time just knowing what you have so you know what you need to do. Right. And that's what all of these tools are designed to do. And if you have any questions about how to navigate any of this or whatever you're seeing here, right, and we don't get to them tonight, that's where the student debt message board area is really going to be your best friend. Right. So anybody that's a veterinary student can post here regardless of their VIN member status. You can see that Becca and I do a lot of counseling for our veterinary colleagues in here. There are thousands of these in here. Right. So if any of you are familiar with VIN and how it works, the heart and soul of VIN are the message boards where we have colleagues helping colleagues. Right. So most of it is medical cases, right? Hey, have you ever seen this? Or I don't have a lot of experience with this. Can somebody, talk me through how to do this? We kind of stole that concept and applied it to your student loans, right? So everything that we've learned and everything that we're presenting to you tonight is from a decade or more of Paul Pyan and I, myself, Becca, working through these cases, you guys, right? Helping you develop repayment strategies so you can get past the good, bad, and ugly associated with your student loans, right? So you can use this, you can post in here. There's even a way for you to post anonymously. We'll use that student debt and income signalment form you submitted to supplement these posts, right? So if you filled out those student debt and income signalment, then we can help you jumpstart that by posting for you and clicking the anonymous box, right? And then you'll get notifications as we're kind of working through your student loan analysis and physical exam. And as you work your way through repayment, you can come back there, post your questions, update us with your progress, and we can adjust your analysis from there. So that's the My Student Loans tool, right? We haven't touched on the simulator yet, right? But this is just the initial physical exam some of the things we're going to find in here, right? I mean, this is a gold mine of information. And this is the one I told you too, right? So this person borrowed on their pathway to and through veterinary school about $188,000 of student loans, right? That's how much they received. So if you remember back to that comment that I had in the presentation, you know, I borrowed 188 and now my loans are at 270, or they said 280, right? This shouldn't be this high, right? There's going to be some amount of interest that you accrue during veterinary school that will get added to your principal that would have maybe brought this to 200-ish, right? But the reason why this is actually at 230 is because there was a lot of deferment and forbearance periods going on during this residency training, right? And that can be hard to avoid because of the way the system is built, but you can avoid it, right? If you keep your loans in an income-driven plan, if you tell your loan servicer that you do not want the school in-school or the in-school status that your school may report to put your loans in a deferment, then they'll keep them in repayment, right? If you provide your annual income documentation on time each year, you'll prevent your interest from getting added to your principal. But that's one of the reasons why this total is higher than it otherwise should be, right? Is because their loans capitalized a couple of different times during their residency training, and that's preventable, right? It's preventable if you know what student loans you're dealing with, if you know what plan your loans are in, and if you stay on top of the income-driven recertification deadlines each year. So for those of you that are in the pandemic forbearance benefit or taking advantage of that, is currently set to expire at the end of August. You can request a refund of any payments that you've made during the forbearance. Some of you told me that you've been making payments even though your minimum monthly payments are zero, right? If you're doing an internship or residency, I'm guessing that money can probably be used elsewhere, right? So request a refund. Go to your loan servicer and say, hey, I've been making some payments during this pandemic forbearance period. It started March 13th of 2020. So any payment you've made on your loans since March 13th, 2020, you can request a refund of, right? And as we illustrated with that example, your recertification may get pushed way out into the future, at least beyond March of 2023. So here was somebody that told me, hey, I'm working towards public service loan forgiveness. I made a huge lump sum payment. How do I fix it? Well, if you made that lump sum payment during the pandemic forbearance period, ask for it back, right? Ask for that refund. Go to your loan servicer and say, hey, I want that back, right? And if you are working towards public service loan forgiveness, there's never a reason for you to pay any more than your income requires, right? So if your payment is zero, let it be zero, right? If you're earning public service loan forgiveness, there is not any good financial reason for you to pay $1 more than your income requires. And right now, nobody has to make any payments, right? So you may get a do-over here, right? Because of this special pandemic forbearance period. Now, if you made that lump sum payment before the pandemic forbearance benefit started, you're out of luck, right? So use that as a learning experience and don't make that mistake going forward.
Tony, there's a really great question that I think is going to get a lot of traction here. How do you
Sure.
determine if the institution you work for qualifies for PSLF?
Yeah, well, you know, it's how do you determine? So $1 million question. So your institution is most likely a 501c3, right? So I think I'm pretty sure that every US veterinary institution is a 501c3 nonprofit. Now they can still be a private organization, but they're still a 501c3 nonprofit. If they are a 501c3 nonprofit, then they are technically eligible for public service loan forgiveness if they are willing to consider you as an employee, right? And that's the rub, right? Are you an employee, right? So if you can go to your residency coordinator there, or whatever the equivalent of your human resources professional that kind of, you know, handles your pay stubs and your health insurance and, you know, the mechanics of all that, or you can even get your, you know, supervisor to sign off on this. If they're willing to check the box that says you're an employee while you're doing that internship or residency, then you'll receive credit as long as you're using an income-driven repayment plan. Right now, some programs are willing to sign that employment certification form, some aren't. Right now, I believe that 100% of them should be. right? Because the language is flexible enough where they can, consider you an employee, even if you're a resident and partially a student and mostly an indentured servant, right? But the language there is flexible enough where if you can find the right person there to sign off on the form, then you'll get your public service loan forgiveness credit as the person who I showed you did. And I believe that their residency, well, I don't want to say where it was, but it was a veterinary school residency, right? So some of them, it'll be easier for you to get that credit documented than others, right? But just because they tell you no, I might ask 2, 3, 4 other people there before I find somebody that is willing to say yes, right? Because I believe that they all should, right? And I believe that they should be advertising that as part of their residency programs. The physicians do, right? All of the physicians that are working their way through training are getting public service loan forgiveness credit, right? But for some reason, we feel like we're different enough that, we're not going to, consider our residents to be employees, right? So, and soapbox there. But I think you can find somebody at that institution that'll be willing to sign off on that form that will meet that employment portion of your residency qualifications.
And what about if it's a university that's not in the US? Is there any way to qualify?
Oh, yeah, great one. So unfortunately not, right? So the 501c3 designation, it deals with US organizations, right? So unless, it'd be really hard. I mean, this would be like a unicorn, right? If there's somehow a US headquartered organization that has a foreign satellite place that still meets the 501c3 requirements, you might be able to get some public service loan forgiveness credit. But generally speaking, the 501c3 designation really only applies to organizations in the US, right? So that's a US designation. So unfortunately, probably not, right? Unless you're paid by a US employer while you're doing that training overseas, that could be another way for you to potentially earn public service loan forgiveness credit. But if you're probably not going to be able to get that public service credit, you can still use an income-driven repayment plan while you're working overseas, but you're probably not going to be able to get public service loan forgiveness credit.
There's somebody here with the $1 million question. Why do some institutions not want to sign the Pslf paperwork?
Oh God. Yeah, I don't, that's going to be from institution to institution. I think that some of them, because you guys have this, it's so bizarre, these programs, right? I mean, you guys work 80 hours a week, right? I mean, they consider a full-time employee, to be 30 hours a week, right? But they look at that and they're like, well, this person is partially an employee, they're partially a student, so we say that they're not really a full-time employee, right? And they get hung up on that full-time language because that tends to mean different things in labor laws, but it's completely different if you read the public service loan forgiveness employment certification form. So to me, if you find somebody there that is, I guess, flexible enough to say, yeah, this person is definitely working more than 40 hours per week, and, they're meeting what we would consider an employee designation, then that's all it really takes, right? For you to get somebody that's at that 501c3 organization to acknowledge that you meet these public service loan forgiveness requirements. And again, it's been done. It's been done for years and years in various medical capacities, and it's being done in veterinary medical training capacities too. It's just not being done consistently, right? So it really is just going to be, the person that you can find there. And hopefully I keep saying various versions of this answer to the academic institutions themselves when I can get in front of those folks, right? So hopefully, over time, we'll see more consistency, but you may have to kind of blaze that trail yourself if you're kind of facing that, where do I want to do my residency decision? Or, eventually we may get to a point where if you tell, let's say you've got your choice of 3 different residencies and you choose the one that says, yeah, we're willing to sign that public service loan forgiveness employment certification form, and you tell those other ones that's why you chose that one, well, maybe they'll get the message, right? So, go around as you're kind of interviewing these places, as they're interviewing you, you're interviewing them. Bring one of those public service loan forgiveness employment certification forms with you and show it to them. Hey, have you ever signed one of these? Are your residents earning public service loan forgiveness credit? If the answer is or no, then say, all right, well, I might look for one that is, right? And again, it's really their choice. They're choosing to not do that, right? There's really no reason why they can't make that work under the public service loan forgiveness rules.
Before you get too far down the line, we have two quick questions about consolidation here. The first one is, so in your opinion, is consolidating all loans, including HPSL right now, more beneficial than taking advantage of the deferment years, about 4 years for internship and residency for the HPSL?
I believe it is. Yeah, particularly if there is any potential for you to earn public service loan forgiveness, then absolutely. If your total student loan balance is such that you don't ever see your income even immediately after the training exceeding that debt balance, then absolutely. Right. You know, I have seen people try to play the game where they keep their direct loans in an income driven plan and they keep the health professional student loans outside of the consolidation so they can benefit from the no interest accrual, but it's such a minuscule amount. And then all of a sudden that person does a career shift and now they're in a public service loan forgiveness eligible employment situation. And they're like, damn, why didn't I consolidate these? Right. And this is, I guess I'm going to sound like a broken record, or maybe you've heard me say this before, but out of the thousands and thousands of colleagues that I've helped with student loans, I have never looked at a portfolio and said, wow, it would have been better if this person didn't consolidate their loan. Never. Right. But I can't tell you how many times I've looked at loan portfolios and be like, damn, it would have been a lot better and a lot easier if this person would have just consolidated after they graduated. Right. So take advantage of that. Right. I mean, you might be able to squeeze a couple of nickels out by, you know, not consolidating your health profession student loans, but you lose a ton of flexibility. Right. So it's just better to take advantage of that flexibility because you never know where your career might take you. And you can't go back in time, right? There has yet to be an announcement in any of these really beneficial announcements that allow you to reconfigure those health profession student loans to get past credit, right? So I wouldn't count on that in the future.
And then if I have direct unsubsidized loans from each year of vet school, do those count as separate loans that I should consolidate, or does the consolidation only apply to different types of loans?
No, they'll take each one of those direct unsubsidized loans and they'll treat them as a separate loan, right? So if we come back to our example, they have that exact same thing going on, right? So they've got 7 direct unsubsidized loans. They've got 4 direct grad plus loans, right? They even have some subsidized loans from grad school. Those are all treated as separate loans, right? When you consolidate them, they'll lump them all into 1 or 2 loans. Right. So that's the goal of the consolidation, is to clean up all of this. It'll even include these FFEL program loans. And if you have the health profession student loans, it'll include those as well. And it'll make them eligible for all of the income driven repayment plans and public service loan forgiveness programs that we've been talking about.
All right. I think some of these are going to hit in the next couple slides here. So
Okay.
I'll let you keep going.
All right, great. So internship, right? The numbers are not staggering. You guys are all very familiar with this, right? The average range, depending on whether you're doing an academic internship or a private practice internship, falls somewhere between 32,000 and 46, right? There are some outliers there, of course, but this is the average, the range of averages. Post-internship, if you do an internship only, generally speaking, the data is not that favorable, right? Post-internship folks are generally earning about the same as new grads. That changes if you're doing kind of an emergency internship program, right? But we don't have a lot of robust data on that. But the post-internship salaries are not terribly different than new grad salaries. But internships are the gateway to most residencies, right? So the residency average incomes are between 38,000 and 50, again, depending on whether you're doing an academic or private practice. Now, interesting dynamic, most internships are private practice, right? So the averages tend to be dragged up a little bit higher because the private practice internships are paying a little bit more. Most residencies are in academic institutions. So you could have a scenario where you earn more as an intern than you do as a resident, right? So because most residencies are academic institutions, so the average tends to be a little bit lower. But either way, incomes, this is why I call this financial damage control, right? I mean, McDonald's managers are making more per year than most veterinary interns and residents, right? I know that's sad, makes you want to cry, but it's the reality, right? And it's also why you shouldn't be trying to pay aggressively towards your student loans while you're navigating this internship and residency pathway, right? You're going to have to, minimize the damage that your student loans can do, right? If you're not careful while you're not making very much money. The other thing that's really, really annoying is that we don't have a lot of robust data for what you're going to earn in the various specialties. Now, some of that has changed recently. So there's some pretty good reports on what ACVIM specialists are earning, what surgeons are earning. And the surgeon one's is a little bit dated, but at least there's some data out there that you can access, and those are in the various journals for those respective specialties, right? So look around for that information. If you're in a residency and you're having a hard time finding the income data for that specialty as you're approaching the end of it, then ask them, right? You're a member of that specialty college as a trainee. Get them to start putting some more information out, right? Because it's really, really frustrating to not know what some of the ranges are of incomes that you can expect to earn, not only so you can plan for your student loans, but it helps you when you're negotiating that first salary after your residency, right? So you guys are members of those. As you're even in the training program, start pushing on the leaders in those organizations to start putting out data for those various specialties. So how do they calculate your payment, right? So even if you're earning 30, 35 grand a year, right, an income-driven repayment plan, while it'll be a little bit greater than zero when the pandemic forbearance period is not in effect, there's some advantages to doing that. So if you're earning $35,000 a year as an intern or a resident at an academic institution and you're a family size of one, right, they're going to calculate your discretionary income. So we're going to take our salary or our taxable income. We're going to subtract off 150% of the federal poverty guidelines to give you kind of a basic living allowance, if you will, right? Our discretionary income is about $15,000 per year. They're going to take 10% of that if you're using pay-as-you-earn or revised pay-as-you-earn, divide it by 12. The minimum monthly payment would be $122 per month, right? So how much is an appropriate monthly payment when trying to balance rent, auto payments, and other monthly expenses? If you're out, when we're outside of this pandemic forbearance period, right, depending on what shows up on your tax return, right, we can calculate that, right? But hopefully, if you're earning $35,000 a year, that $122 per month payment will still allow you to meet that rent, auto payment, other monthly expenses, right? Because it's going to be more beneficial for you to make that minimum monthly payment while you're doing your internship or residency than to defer it, have the interest accrue, and then have the interest get added to the principal afterwards, right? And also, deferment doesn't count towards any of the forgiveness programs that we've been talking about, right? So you're kind of paying to make sure that your loans are on track, receiving some kind of credit towards forgiveness, and to prevent that interest from being added to your principal when you're done with your training, right? So we've got a bunch of different levels of income here to show you what that monthly payment would be using pay-as-you-earn or revised pay-as-you-earn. Hopefully you can work that into your budget. I know they're tight, particularly as you're an intern or resident, but see if you can make that fit into your budget. But again, during the pandemic forbearance, you don't have to make a payment, right? If you watch the new grad playbook, right, and you filed a tax return before you graduate, or you applied via your consolidation before you start your internship to get a $0 monthly payment, and you can get that $0 monthly payment for at least a year, there's a good chance that you won't have any payment for the first 2 years of your advanced training, right? Because you don't have any income from your 4th year as a vet student, or you don't have any income before you start your internship. So you'll have a $0 monthly payment. If you're starting that internship this year, you're only going to report half of your income when you file your taxes at the end of this year. So $17,000 or so when you file your taxes for 2022, that will also trigger a $0 monthly payment for the following year, right? So you can have the same effect of a deferment if you're careful in how you're planning this income-driven repayment plan, where you can have a $0 monthly payment for the first 2 years of your advanced training, and then get all of the benefits that we just talked about: forgiveness credit, prevent the interest from accruing on your student loans, right? So those are really huge benefits in the long run if you can navigate those appropriately. So how much does your income require you to pay? Are you paying more or less than that, right? If your payment is zero, don't make a payment, right? It's okay. You know, the $0 payments will still count towards forgiveness as long as you're enrolled in an income-driven repayment plan. If you're married, it gets more complicated, right? So great question here. Best repayment option for married, high combined income while I'm doing a residency PhD. Well, if the high combined income is coming mostly from your spouse, right, then you want to think about filing your taxes separately from your spouse, right? You can do that, right? Now, it's going to get a little bit more complicated because only certain income-driven plans allow you to exclude your spouse's income when you're married if you file your taxes separately, right? So the first thing is knowing which repayment options you're eligible for, right? So pay as you earn, IBR, those are the plans that allow you to separate your income from your spouse if you file your taxes separately, right? So you have to be using one of those. And then you also have to have or will have a separate tax return on file in order for you to be able to exclude your spouse's income from the calculation. Repay is a little quirky, right? Even if you file your taxes separately, if you choose to use Repay, they're going to want to see your spouse's income before they calculate your monthly payment, right? So this is one of the bigger mistakes I see. People are like, oh, well, I'm going to use Repay because of the unpaid interest subsidy. And maybe I think my income is going to exceed my debt after my specialty, but I'm married during my training, so I file my taxes separately. You're kind of shooting yourself in the foot there, right? Because you're still going to have to provide your spouse's income, and you're also probably paying more in taxes because you're filing your taxes separately, right? So you have to make sure that these things align appropriately. So pay as you earn, IBR will allow you to separate your income from your spouse if you're filing your taxes separately, right? Then you can have your payment based only on your income, right? Which can be very beneficial, particularly if you are on a public service loan forgiveness or other forgiveness pathway. When you file your taxes separately, you'll probably pay a little bit more in taxes. You may lose some other benefits, right? But generally speaking, you're going to save more than those benefits are worth in student loan payments, right? You're going to have to crunch the numbers, and they can change from year to year, right? So you can file your taxes separately this year and file them jointly the following year, then switch back to separately after that, right? So you can change your tax filing status from year to year, depending on which one is going to keep the most money in your overall family budget. All right, so the length of repayment, how long will I be in repayment? There's a maximum repayment period for these plans, right? And I find a lot of confusion around this, right? So pay as you earn, new version of IBR, 20 years maximum. Revised pay as you earn, the plan my wife and I are using, 25 years maximum. Right now, even if you use an income-driven plan, you can end up paying your balance to zero before you hit that maximum, right? So you can use an income-driven plan and not have to worry about forgiveness if your income is high enough, right? And for some of you, that may happen, right? Some of you that are going to become surgeons and neurologists and ophthalmologists or, cardiologists, you're going to have the opportunity to earn some pretty significant income. And you may end up paying your loans to zero, even if you started using an income-driven repayment plan, and that's okay, right? That's honestly, to me, in my opinion, that's the preferred way, right? Because you're still never paying more than 10% or 15% of your discretionary income towards your student loans, right? Now that income will either be high enough where you pay the balance to zero, or it won't, right? And if it isn't, then you'll hit forgiveness, right? Now public service loan forgiveness has a 10-year maximum repayment period, right? But that is more, how 10 years of qualifying payments, right? So after you reach the 10 years of qualifying payments, then you can apply to have your remaining balance forgiven and not have to pay tax on it, right? So your loan balance can be forgiven, right? Or you can also end up paying your balance to zero, right? It really depends on what your income does during the course of repayment. But the longer that you're in a low income status, right? So let's say you're using pay as you earn and you're doing an internship, maybe a second internship, a 3-year residency, 5 years into a 20-year maximum repayment period, right? It's still quite likely that you're going to hit forgiveness, even if you earn a significant amount of money, right? So that's what the loan repayment simulator is going to help with, right? Is running those simulations, right? So if we come back to our equine practitioner, right, who's got some qualifying public service loan forgiveness time, but they also have the opportunity to earn $125,000 as a specialist is a private practice, right? So I'm going to send this over to the in-school loan estimator. I'm sorry, I'm going to send this over to the student loan repayment simulator. Let's just assume for time being that their overall average interest rate is 6%. And if they use auto pay, they'll get a 0.25% interest rate discount, right? And this person actually graduated 2016. They've been using pay as you earn for 5 years. They do have public service loan forgiveness credit, but let's pretend they're going to kind of abandon that for now, right? We know that their income is going to be 125,000. Right? We have to kind of assume some increases to that income over time. They're not married yet, right? So we'll leave that out. We've got some advanced simulation setting, but you can, if you are married or you will be married, you can fill in that information, right? What your spouse earns, if your spouse has student debt, how many children you have, or if you plan to have children in the future, right? All of those things will impact your loan repayment simulation. We're going to leave all this the same here. These are all the advanced simulator settings. If you're going to hit forgiveness, we can assume a tax rate. You can change that to whatever you think is appropriate. If you're going to build a forgiveness savings plan, like I illustrated my wife and I are doing, we can put in what we think the growth rate will be for that, right? The poverty growth rate is what affects that discretionary income formula that I showed you, right? The poverty thresholds get updated each year loosely based on inflation. So the last couple of years and the next couple of years, we're probably going to see that poverty growth rate, increase pretty significantly. But over time, it tends to even out somewhere around that 3% inflation rate. Once you start to build a forgiveness savings plan, you can start to put that in there. So we'll account for that. If you're going to make additional monthly student loan payments, we can account for that to show you the impact as well. But let's run this, right? Just to give you an idea, somebody who's got $270,000 of student debt, right? You'll notice here, because they're using pay as you earn, right? This number is lower, right? Because the principal is what is going to accrue the interest going forward. If I were to switch plans, right, I would take that interest and have to add it to the principal, which is why all of the other columns here have a higher number. Here's our interest rate. Our monthly payment at 125,000 would be $872 per month. If we wanted to pay it back faster, it would be closer to $3,000 a month, right? Now, some of you may want to try to do that, right? And you may be able to do that, right? But just know that if we keep working our way down here, just based on our projection for our income, we could end up paying more if we try to pay it off faster than if we pay the minimum required by our income and plan for the forgiveness, right? In this scenario, I am projected to hit forgiveness, right? 270,000, which is a little bit higher than what my balance is now. So it's going to have that unpaid interest forgiven, including the principal. If I assume a tax rate of 30% on that, I'm going to have to pay maybe $81,000 if I have to pay that tax 15 years from now, right? Because I already have about 5 years of qualifying credit, right? So we have to account for those things. If I already got 5 years of credit, I got 15 years before I hit forgiveness, right? I probably haven't built a forgiveness savings plan during my residency because I wasn't earning very much, but I can start now. I've got 15 years before I hit forgiveness. If I allocate $358 a month and I earn 3% return on that, then I'll have the $81,000 I need on hand. And that reduced my costs even further, right? So here, there's nearly $100,000 difference between paying the minimum, planning for the forgiveness, than trying to pay it back faster, right? And this is where it's really important to know where you are in the time frame. It's hugely helpful if you have an idea of what your income is going to be after you finish your specialty training, because then we can start projecting it. But we can see here there's a significant amount of cash flow difference too, right? I pay based on my income. It's a manageable percentage of my income. If I'm paying aggressively, it's not a manageable percentage of my income, right? In this case, I've got $120,000 of additional cash flow over a 5-year period by making payments based on my income. And that can help me, buy a home, jumpstart my retirement savings, build a family, right? Buy a practice, start a practice, whatever your career, financial, family goals are, that cash flow is there if you're pegging your student loan payment to a manageable percentage of your income. And in certain cases, like we see here, you can end up paying less by pegging your payment towards your income and planning for the forgiveness. right? So that's what the simulator can show you, right? So depending on where you are in this process, I would encourage you to fill in your numbers. And while we're here, ask some questions about it.
We actually have some questions there about the forgiveness. If I were to switch from one IDR plan to another, for example, from pay to repay, then would my time till I reach forgiveness remain the same, or would it start over?
Yeah, so switching plans will not start your forgiveness clock over, right? But it will capitalize your unpaid interest, right? So what was it? What are we switching to there? Are we switching from repay to pay or pay to repay?
Pay to repay.
Yeah, so I would want to know more about why you'd want to do that. So generally speaking, it probably makes a little bit more sense to go the opposite direction once, right? There's usually not a,
Oh, we got a sorry, repay to pay.
okay. So that, yeah, that would make more sense to me, but the same thing applies, right? So this is another thing I'm going to talk about later, right? One of the bigger mistakes that I see people make is plan switching, right? Now, you know, one time, cool, right? But every year, not cool, or every other year, not cool, right? So you want to keep the switching to a minimum. So some of the cases that I see where it makes sense to switch, maybe I thought that I was on a specialty pathway that was going to be a slam dunk to have my income be greater than my debt. So I chose repay. Well, maybe that's not panning out, right? I didn't get the residency the first time around. I'm doing another internship. Maybe I'm thinking about doing a different specialty that pays a little bit less. I would get from repay to pay quickly, right? So you'll have maximum flexibility. If you're using IBR and didn't know that you were eligible for repay and didn't have access to pay as you earn because you didn't know repay was a thing, that's a cool, that's a cool reason to switch, right? But you may want to double check that depending on your marital status and tax filing status and all that jazz, because repay doesn't allow you to separate your income from your spouse. IBR does, right? So repay, again, you can use it in very specific circumstances, but it usually are for those of you that have that slam dunk, I'm going to earn more than my debt balance, regardless of how my career path pans out. Repay is a pretty solid strategy. And if it doesn't pan out, I can switch to pay as you earn. It's not the end of the world. But going from pay to repay generally doesn't usually make a lot of sense.
If I've been on pay for the last couple of years, would I have to restart the time until forgiveness and lose out on the past couple of years if I choose to consolidate my loans now?
Yeah, so consolidation, this is a can of worms. Consolidation generally restarts your clock. However, the announcement that was just made April 19th for certain loans that are consolidated, they can be considered for past forgiveness qualifying time. So you have to be a little bit careful on which loans you're consolidating, and it may not make sense to do a full consolidation. You can consolidate part of your loans, right? So in this case, so let's say this is a perfect example. Let's say that this person wanted their FEL program loans to be eligible for pay as you earn. They can consolidate just this chunk of their FEL program loans. They would choose the same loan servicer, right? So all their loans would be in the same place. So Fed loan servicing FIA here. And that would also preserve their current forgiveness eligibility that they've already earned on their FEL program loans, because there is a special exemption for FEL program loans that are consolidated right now to be considered for past forgiveness qualifying payments, right? So if you just discovered that you have FEL program loans and you've been making payments using an income-driven plan, consolidating those FEL program loans between now and the end of the year is a great idea, right? Because you are otherwise exempt from that restarting of the clock business that normally happens when you consolidate your loans, right? So it's kind of a, special partial time machine for those of you that may just be getting into this loan stuff right now. Again, these announcements that have been made recently are extremely beneficial. So hopefully that makes sense, right? If you're not quite sure, or if you want us to dive in a little deeper, then that's where I would encourage you to post on the student debt message board area, because this is some uncharted waters, right? So you have to be careful if you haven't consolidated your loans. This is one of the reasons, again, why I'm just a huge proponent. If you're in that student or new grad seat, I can't tell you how lucky you are right now to be able to consolidate all of your loans without having to go through all of this messiness that I just tried to explain. Right now, if you're not one of those people, right, and you're not quite sure how to navigate the consolidation, then post in the student debt message board, because it gets the consideration gets way more complicated as the further we get from school when we talk about consolidation.
Yeah. During our 90-minute check-in here, I want to go ahead and cover some of these questions about stuff that we've discussed already. If you are trying to consolidate your HPSL loans that you got through your school, is your school your loan servicer?
It's going to depend on where those loans are living, right? So your school might still be the loan servicer if they haven't moved them yet, right? So you might want to check in with your school financial aid office or log into your school financial aid account to see who is the holder of those loans currently, right? Because when you consolidate them, they're going to want to know who the loan servicer is at that moment, right? So you may even want to reach out to your loan, your financial aid office at your school to see if they plan to move them anytime soon too, because that could impact your consolidation as well.
I am planning on working towards PSLF. When I graduated, Ed Financial was the PSLF servicer, and I chose them to be my loan servicer when I consolidated. I heard they're no longer going to be the servicer. Can I change my loan servicer to whoever the new one is?
So that's Fed loan servicing. So Fed loan servicing is or kind of currently still is the one that I'm showing on the screen here. Fed loan servicing was the one that is responsible for monitoring public service loan forgiveness progress. They quit, right? And they're in the process of transitioning all of their loans over to MOHELA. MOHELA is going to be the new public service loan forgiveness monitor, right? So if you already have demonstrated public service loan forgiveness progress, they will move your loans to MOHELA already. You won't have to do anything, right? But you don't get to choose your loan servicer unless you're consolidating, right? So another reason why consolidating immediately after you graduate is the most ideal time. And for those of you that are in that position, choose MOHELA as your loan servicer, right? Because those loans, once you submit one of those public service loan forgiveness employment certification forms and you document any kind of progress, they're going to move your loans to the official loan servicer who monitors that progress. That's going to be MOHELA once Fed loan servicing phases out at the end of this year.
The servicers get to quit. Why don't we get to quit our
Yeah,
student loans?
right, exactly.
We have one year. I had about 1 year of PSLF credit before vet school. After vet school, I consolidated my loans, except the ones I was already paying towards PSLF. Are those two on two different timelines towards PSLF?
Probably, yes, but that was a great move. So great job recognizing that and leaving those out of the consolidation to preserve that prior public service loan forgiveness progress. But because you had some eligible time before vet school, right, the vet school loans are only going to be able to start from where you're starting that public service loan forgiveness eligible time now on those loans. You're going to have two different public service loan forgiveness clocks, right? So you'll have two different times that you'll apply to have your loans forgiven under public service loan forgiveness once you meet the 10-year qualifying threshold for each of those groups of loans.
If you consolidate, how does that affect your interest rate per loan and grace period?
It won't affect your interest rate. It calculates a weighted average, right? So you'll pay the exact same amount of interest on your student loans that you were paying before the consolidation that you will after the consolidation. In some cases, after repayment starts back up and you use the auto pay, your interest rate with the consolidation loan will actually be slightly less, right? But your interest rate won't change. It's a weighted average interest rate. So it's the same interest you were paying before. It's just in one loan versus dozens of loans. When you consolidate your loans, you want to end any remaining grace period, right? So as part of the loan consolidation process, they'll ask you, what do you want us to do if you have a remaining grace period? And you want to select the do not delay processing option, right? Because that will end your grace period and put you into the income-driven plan that you chose as part of the consolidation after the consolidation is complete, and then those loans will start earning forgiveness credit, right? You don't want to preserve the grace period because the grace period doesn't count towards forgiveness.
Would you recommend consolidating undergraduate subsidized loans that won't accrue interest during my internship, especially considering the possibility of federal loan forgiveness for undergrad loans? Would you not be eligible if they are consolidated?
No, you'll still be eligible. And if you have subsidized loans that you're putting into your consolidation, they will track those separately, right? So I wish I could demonstrate this. I might be able to. I have, because I graduated school back in the dark ages now where they still allowed subsidized loans during grad school. They don't allow that anymore, right? So I have a pretty significant chunk of loans that are subsidized. Let me see if I can demonstrate this if I use the consolidation for my loan. So I have this $50,000 are subsidized, right? So if you have a chunk of loans that are in the subsidized category, my loans are consolidated, right? So this other chunk is unsubsidized. So they will keep those in two separate loans. The subsidized loans will be in their direct consolidated subsidized category. The unsubsidized loans will be part of the direct consolidated subsidized category, right? So you will still preserve that subsidized feature of those loans even as part of the consolidation.
And then one more during this break here. I'm a resident and full-time PhD student, but my salary and benefits are paid through the USDA. I am technically listed as a contractor through USDA.
Yeah.
Can I still apply for Pslf as a contractor, but also a resident?
You can try, but it probably won't fly. So yes, those are some very special arrangements that don't lend themselves well to the employment requirement under the public service loan forgiveness requirements. So yes, and that sucks. You can try to see if they will consider you as a employee for the residency part, right? And maybe earn some public service loan forgiveness qualification time during that residency portion of the PhD. But yes, that is a complicating factor. Those PhD programs, while you still can keep your loans in an income-driven plan, it's very difficult to get those PhD programs to be eligible for public service loan forgiveness.
I'll let you move forward here and we'll do another question break.
All right, great. Thank you. Cool. So debt to income ratio. This is one of the things that you can use to help decide which repayment strategy makes the most sense for you, right? So what is your debt to income ratio now, right? So for most of you that are new grads, interns, residents, your debt to income ratio is probably much greater than 1, right? And being much greater than 1 lends itself very well to income-driven repayment plans. But what you also want to be thinking about separately is what your debt to income ratio will be after your training, right? So where does it fall now? It's probably somewhere in this category, which means income-driven repayment is going to be your best friend, right? But then we also want to consider what is it going to be post-training, right? So if you think, and if you're reasonably confident, now some of this is going to require a crystal ball, right? If you're reasonably confident that your debt to income ratio is going to be less than 1 after your advanced training, right, then I would use Repay, right? So Repay has an unpaid interest subsidy that while you're making low or no payments towards your student loans, the government will cover half of the interest that's accruing, right? That can be extremely beneficial, presuming that you're not going to hit any kind of forgiveness and you're going to pay the balance to 0 before forgiveness, right? That will reduce the amount of interest that you ultimately end up paying, right? But this really only works if you end up paying the balance to 0, right? And that's going to be easiest if you're relatively certain that your debt to income ratio is going to be less than 1 after you finish your training, right? If there's any question whatsoever about whether or not that's going to happen for you, then use pay as you earn, as long as you're eligible for it, right? Because that's going to give you the maximum flexibility to separate your income from your spouse if you get married along the way, if you end up working towards public service loan forgiveness and it makes sense to keep your payment as low as possible, right? That would be or if you're going to end up hitting forgiveness and potentially have to pay the tax, as we demonstrated in the simulation, right? Pay as you earn is going to be the most flexible in that scenario. For those, there was somebody that asked a question about here. So this was a great one, right? How do I know what to do if my residency plans don't work out? Pay as you earn, right? That's what you do, right? And again, if your debt to income ratio is going to be greater than 1, whether your residency plans pan out or not, pay as you earn, right? It's only kind of, I've already accepted my, surgical residency, or I'm in the midst of my residency now, and I know my debt to income ratio is going to be less than 1 after, that repay is probably the better strategy, right? But again, that you can see there that does kind of require a little bit of a crystal ball and some gambling, particularly if you're in the early stages of this decision process. Okay, so let's try to cover some repayment option side. I really want to cover the side effects more than anything, because we've covered a lot of what the repayment options look like just using the simulation as a demonstration. But when it comes to your student loans, I really understand the desire to try to pay those off as fast as possible, but just by nature of the repayment options that you have available to you, the best is not always the fastest, and the fastest is not always the cheapest, right? Again, kind of thinking back to that simulation I ran for that specialty equine practitioner, right, who it looks like they're going to hit forgiveness based on what our best guess of their income is right now. It doesn't make sense for that person to pay more than their income requires, right? They're just going to forfeit a good chunk of their cash flow just to end up paying more than they have to towards their student loans, right? That doesn't make good financial sense, right? So when you think about your student loans, a better way to think about them is what's the best way to reduce the risk to myself and my family first, maximize my monthly cash flow, which essentially means keep my monthly payment as low as possible. And then if I can, reduce my total repayment costs, right? Most people are over-focused on this third one. Now, sometimes we can get all three, and a lot of you will get all three, particularly if your debt to income ratios remain above 1 for any appreciable amount of time, right? But even if I don't get this third one, I still want to use income-driven repayment because I know it's going to satisfy the first 2 bullets, and those are way more important, right? I know that if I get hit by a bus tonight, tomorrow, this weekend, right, my wife or my daughter do not have to pay my student loans, right? There's some huge insurance there. I also know that if I lose my job tomorrow, or if my wife can't go back to work and doesn't earn any more income, right, that our monthly payments can go way down on our student loans because our income went down, right? You will never get that kind of flexibility on any debt that you will have for the remainder of your life, right? So don't be too flippant with that, right? That's a huge, huge point of benefit and flexibility, right? If it takes you a while to figure out where you belong in veterinary medicine, and that pathway has some pretty low income associated with it, that's what income-driven repayment is for, right? If your career has, your dream job has you working or choosing a position that may not come with a lot of income associated with it, those income-driven repayment plans are going to allow you to navigate that and still choose that career path as opposed to something that pays higher that may not be what you want to do. Right. So there was a lot of good questions before too earlier, I was part of the Signalman Forum submission about, I don't want my student loans to dictate my career. Well, they don't have to, right? You can pay based on your income, right? As long as you're still planning for the forgiveness, or maybe you're in a public service loan forgiveness eligible employment position, right? As long as you're treating your loans appropriately, you don't have to worry about them preventing any of your career aspirations. So this is we've already kind of covered this. These are the options that you have, but I wanted to dive into the forgiveness provisions really, right? So, forgiveness is really kind of a point of confusion. Should I be paying more over my $0 monthly payments, right? No, right? Particularly while you're earning an intern or resident salary, absolutely not, right? You want to make sure that you're staying out of credit card debt, or maybe, saving for retirement or building an emergency fund, right? Those are way more noble uses of your money than paying a few extra dollars towards your student loans, even if your payment is zero, right? So really focus on what your options are, what are your finances, what does your income require you to pay, and what, using the simulator, what are my long-term ramifications if I run this out to the end of the forgiveness programs, right? Will I reach forgiveness, right? Is there a tax? When can I start planning for that tax? Right? There's some of these other questions that always come up. What if the government cans these options in the middle of repayment? And there's just really no evidence of that, right? I mean, the evidence has all been to the contrary. At every step along the way, every change that has been made to these plans has been an improvement, right? There has never been a scenario where there has never been a provision that has been taken away or a benefit that has been made less beneficial. There has only been improvements and increased benefits. Now, if you only read the news, all of the student loan repayment plans are a disaster. And yes, to a point, right? They're a disaster in that they were not quite conceived perfectly, right? And we're seeing the ramifications of that. But there is tons of information out there now on how to avoid the pitfalls that many of our predecessors have found themselves in, right? It was way more difficult to know some of these things that some of these people fell prey to previously than it is now. And they're going back and trying to fix all of the things that happened to those previous people now, right? So those people that didn't do the right things to be eligible for forgiveness or public service loan forgiveness are getting second, third, fourth cracks at it. It's going to take some time for that to play out, but it's amazing to see that they're actually going back and trying to make that right. Right. And most of you that have graduated fairly recently aren't going to fall in any of those traps anyway, because most of those traps have been removed. Right. And, if you need to kind of navigate some of those because you're a career changer that has some older loans, we can help you navigate that process. But most of you don't have the loan portfolios that will make it so you will fall into those previous traps that were in place before. When it comes to which plan is better, pay as you earn or repay, that's where you're going to run simulations, right? That's really going to depend on the specifics of your circumstance, what the numbers show, your marital status, the income for you and your spouse, your family size. All of those things are going to help answer that question. And you can put all of that into the simulator to see. When it comes to public service loan forgiveness, you guys have all asked a lot of great questions about this. We've covered this. I just want to make sure that everybody's clear, right? So technically speaking, only direct loans are eligible for public service loan forgiveness. Now, there are some special exceptions for that, but you first want to see that you have direct loans or you have the ability to turn all of your loans into a direct loan using a consolidation. You have to use an income-driven plan to be making a public service loan forgiveness eligible payment. Again, that's changed for those of you that might have been using some other repayment plan in the past for some special exceptions during a special window to have your payments counted outside of income-driven repayment plan payments. But generally speaking, if you have direct loans and you're using an income-driven repayment plan while working for an eligible nonprofit, you are earning public service loan forgiveness credit. And after you've earned 10 years of qualifying credit, you can apply to have those loans forgiven tax-free. Right, so this is just my attempt. Internship, academic internship, I believe all of them should be eligible if you submit that public service loan forgiveness employment certification form. The residencies, again, some of them are, some of them aren't. They all should be. Take that form, knock down the door of a few people to see if you can get somebody to sign off on that. The postdoc ones we just covered with that question about them. Unfortunately, they're very difficult to get to be eligible for public service loan forgiveness because who's paying the stipend for that postdoc or that PhD. Private internships and residencies will never be eligible for public service loan forgiveness. You can still use an income-driven repayment plan, right? And you still could hit the other type of forgiveness, but they're not going to be eligible for public service loan forgiveness. But academia, government positions, other 501c3s, those are all going to be eligible.
We've got a couple questions here, Tony, about having time in PSLF qualifying payments and then no longer working for a nonprofit. So
Sure.
those years of payments go away.
No, they're always there, right? But you have to realize that you have two different clocks ticking, right? So if you think about it, right? So we start putting the puzzle pieces together. Income-driven repayment plans are a requirement for public service loan forgiveness eligibility. These have a clock, right? So if you're using pay as you earn, you have a maximum repayment period of 20 years. So if you earn 5 years of public service loan forgiveness credit while using pay as you earn for 5 years, you've got 15 years before you hit forgiveness on pay as you earn before you can earn the other 5 years of public service loan forgiveness credit, right? So yes, I mean, they don't have to be consecutive. You will always bank that time that you've earned, but it won't last forever because you'll either pay your balance to zero or you'll hit forgiveness under the income-driven plan before you can go back and complete your public service loan forgiveness eligibility, right? So you've got some flexibility and some wiggle room to kind of navigate back and forth, but not unlimited, right? So you just have to kind of weigh, that's where the questions come up. Do I push through and rather than take the private practice position that might pay me a little bit more, but I'm halfway to public service loan forgiveness, what should I do? Right. And that's a very difficult question to answer. But we can run some numbers and show you what the financial ramifications are for that. But ultimately, those are two very different career paths, right? Private practice and potentially academia are very different career paths. So it really kind of, what do you want to do kind of thing, right? And if the finances will help push you one way or the other, then we can run that analysis and help you understand that. So new somebody asked a question about new public service loan forgiveness. There really isn't a new one, right? There really has been a lot of attempts to go back and fix a lot of the errors that were in place when the first version was set up and the first people were applying and getting denied, right? So that's really what I would consider to be new, is that we're allowing people to go back in time and take a second, third, fourth look at everything that they've done with their student loans and their employment history to see if there's a potential to get them some public service loan forgiveness qualification. Right, so that's what's going on now. That doesn't impact anybody who's just getting started in repayment. Right? If you do these things, you will earn public service loan forgiveness. Right? It's law. Right? There's a contract. Right? If you do these things, you will get public service loan forgiveness. The problem for the first early cohorts of people is they weren't really doing the right things. They just didn't know it until it was too late. Public service loan forgiveness will continue, right? At least for everybody that's on this call, right? So public service loan forgiveness could change, but the contracts that we all have currently lay out public service loan forgiveness as an option for these direct loans. So there's no way for them to take that away for existing borrowers, right? They can take it away for people who haven't borrowed yet, right? But nobody's done that yet, right? So I dismiss this really, right? There is no scenario where public service loan forgiveness is going to be eliminated for existing borrowers, right? It might be eliminated for future borrowers, but I don't know what that looks like because nobody's actually written that law yet. All right, so if you're going to work towards public service loan forgiveness, you want to pay as little as possible. Right? You want to have the maximum amount of your student loans be eligible for public service loan forgiveness. Right? You want to maximize the pandemic forbearance benefits. Right? You don't have a payment due. There's no reason to pay one. Right? If you're starting in residency, or like the example we went through, the person who's finishing their residency, starting at a higher income level, but still has a resident payment on their student loans that will last for another year and a half. That's great, right? Take full advantage of that, because who knows, maybe they're going to practice in private practice for a couple of years, decide I want to go back and take that academic position, right? So they want to maximize the amount that can be forgiven tax-free. So it doesn't make sense to try to increase your monthly student loan payment, right? And that actually happens way more frequently than I would have ever guessed. Right, through all of the analysis we've done for colleagues, I'm amazed at how many people move from private practice back into some kind of nonprofit capacity, right? And now they're in a position to qualify for public service loan forgiveness. Now, many of them have made huge payments towards their student loans trying to eliminate them previously that they can't get back. Right. So again, it really doesn't make a lot of sense to me to pay more than my income requires, because I don't really know exactly where I'm going to end up in veterinary medicine. And I may be able to have my loans forgiven and not have to pay tax on them. Right. I've got way better things that I can do with that money than trying to pay off my loans faster than my income requires. Right. So peg your payment to your income and let it keep going until you have, like, the perfect position, or you have the perfect understanding of what your income is going to look like for the foreseeable future. Here's an example of a veterinarian who received public service loan forgiveness. And now they received it, we didn't talk about this tonight, but under the temporary expanded public service loan forgiveness provisions, which is, again, another one of those new parts that have been added on to help people that weren't doing the right things in the past to get them over the hump to public service loan forgiveness. But she had $440,000 of student loans wiped off of her ledger, didn't have to pay tax on them. That happened just this past December, right? This is happening for our colleagues, most of them that have been in repayment for 10 years or more now, right? And some of you are on the path to this, right? So you want to keep working towards it and make sure that you're checking all of the appropriate boxes so you earn it as quickly as possible. So there was someone who added a comment about getting out of debt as fast as possible as an intern or resident. Your income is probably not going to be the way that does that, right? If you want to get out of debt as fast as possible as an intern resident, you're probably going to want to reach public service loan forgiveness, right? So that would require an academic internship, academic residency, academic position afterwards. That would probably eliminate your loans as fast as possible and have you paying the absolute least towards them, right? If that's the goal, then that's what I would do, right? Otherwise, it's going to take a significant amount of income for the average veterinarian to eliminate their student debt as fast as possible. So this is the one that I think is probably the hardest to answer, right? Do I do the public service loan forgiveness, or do I pay more towards my student loans because my income is higher, right? It really depends on the specialty, really depends on your income and your circumstances and where you see yourself going after you complete that advanced training. But we can use the simulation and the student debt message board area to help you answer those questions. Okay, so the side effects, these are the things that you really need to try to avoid, right? Because so here's the things that they're kind of like the unseen bumps in the road, right? So when you're making payments based on your income, you're using an income-driven repayment plan, you quite often have no or very low payment, which means you're going to have interest that builds, right? But it builds separately. It doesn't get added to your principal, or it doesn't have to get added to your principal, right? So this is called negative amortization, when you're making payments that are below the interest that accrues on your student loans. Right now, capitalization is the process of taking that interest and adding it to your principal. Right? Capitalization is very different from compounding. Right? Your student loans do not compound, right? Which is a wonderful thing, right? And you can prevent the capitalization by making sure that you stay on top of your annual income renewal, by telling your loan servicer that if you're doing a residency that involves some kind of master's of clinical science, usually at an academic institution, if you're enrolled as a student as part of your residency, then you have to tell your loan servicer to ignore any automatic in-school deferment requests, right? Because just like what happens when you're in veterinary school, when you receive a loan, you're not required to pay it because your school is sending these automatic deferment requests to the Department of Education that are indicating that you're enrolled in school. The same thing can happen when you're in a residency and you're doing a master's of clinical science or some kind of schooling time that's involved with that residency. That school will send that status to the Department of Education, which will try to put your loans into deferment, right? You can ignore or waive that deferment request if you tell your loan servicer ahead of time, right? And that will keep your loans in repayment. That's what happened to this person, right? So their loans, they receive $45,000 of student loans, but their principal is now $55,000 on that one, right? In aggregate, they've got a principal of $237,000. They've got $32,000 of unpaid interest, right? But they received $188,000, right? That's too much capitalization, right? And that's because they were enrolled in a program that had a master's of clinical science that was automatically deferring their loans. It was going from repayment status into deferment. And when it comes out of the deferment, it takes the unpaid interest and it adds it to the principal, which then has you accruing more interest, right? So you really have to be diligent about making sure that's not happening to your loans while you're a resident, particularly at academic residencies, which are most of them, right? Then you can prevent that capitalization, right? So that changing of the loan status is what really triggers that capitalization of your student loan interest. Changing repayment plans, we talked about that, but failing to renew your income documentation will also be a trigger for that capitalization. But those are all avoidable. All of those things are avoidable. So you can control how much interest gets added to your principal. Don't defer, right? Don't forbear your student loans. And if your school is sending those requests, you have to make sure your loan servicer is aware of that so they can ignore them. All right. So these are probably the top repayment mistakes I see made, right? We talked about a lot of these tonight. Consolidation, procrastination. This applies to new grads. You really, 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 really don't want to consolidate for some reason. It's hard for me to understand, right? You know, maybe because you haven't been in repayment yet, you don't really know how complicated it can get, but you really want to take advantage of that time after graduation before you start your internship or residency to consolidate your loans. It'll make this a whole lot easier. The repayment plan hopping, as we talked about, you know, one or two switches here or there because of mistakes, understandable. But you don't want to, you know, choose and use every repayment plan that's on the books just to see how it works, right? There are consequences to that. Unpaid interest capitalization is the big one. Forbearance, deferment, missing renewals. The forbearance and deferment, not only do they capitalize your interest, but they don't count towards forgiveness, right? So that'll extend the time that you're in repayment. The longer you're in repayment, the more you're going to pay. Paying more than your income requires, right? I mean, for some of you, you just can't stand to have that $0 monthly payment, or if your monthly payment's $50, you really want to pay more, right? Resist the urge to pay more than your income requires, right? You have better things that you can do with your money. The other one that I see frequently are people that are using Repay and they tell me they're filing their taxes separately because they want to keep their student loan payment low. Unfortunately, that's not going to happen, right? Because Repay is still going to require your spouse's income. So those are the biggest mistakes. I think they're all easily avoidable if you know just a little bit about your student loans. So these are all things that I think that are, you know, rightful points of concern. However, they're not a reason to avoid any of the things that we talked about tonight, right? So at the end of the income-based loan repayment, isn't there a huge amount of money you're taxed on? You may have to pay a tax, but if you plan for it, that tax is going to greatly reduce the overall amount that you pay towards your student loans, right? So I see lots of people that do a lot of things to avoid having to pay the tax, and most of them don't have the income to support that kind of strategy, right? The tax on forgiveness, even if we have to pay a tax on forgiveness, is actually going to be a benefit, right? We don't pay 100% income tax on in this country, right? So whatever income tax that you're going to pay is going to be a pretty significant discount on what's remaining, right? But if you plan for it and you use time to your advantage, it'll be easy for you to have the amount you need to pay that potential tax, and you'll even reduce the amount that you have to pay for that by using the power of time, compounding, and the appreciation in those investments. If you have a debt of almost $300,000, how to pay off before the loan forgiveness hits? Don't, right? Pay based on your income. And if you hit forgiveness, plan for it, right? That will reduce your risk and probably your total loan repayment costs, right? So you don't want to necessarily avoid forgiveness, but you want to know if you're going to hit it so you can plan for it, right? That's what this is all about, right? Because you don't want to penalize yourself by paying more than your income requires towards your student loans. You'll have less income in your budgets to work with, which then just has this ripple effect of impacting negatively your overall financial wellness. So prognosis, good. It's okay to make payments based on your income. Your loan repayment will end, right? You'll either pay your balance to zero before you reach forgiveness, or you won't, right? Either is fine, right? But if you're going to hit forgiveness, plan for it. Focus on your financial wellness. There are better things that you can do with your money than paying more than you have to towards your student loans. During the internship residency process, that's that financial damage control. Any extra money that you have shouldn't be going towards your student loans. It should be going towards retirement, emergency funds, down payment on a home, those sorts of things. Those are going to be way more beneficial than, the a little bit amounts extra that you can pay towards your student loans while you're making internship and residency incomes. Flexibility is key. What questions do you guys have?
So we have one here. My loans after consolidation began in December 2020 with pay. What do my loans say? Why do my loans say the scheduled end date to be 2/2036 since that isn't 20 years of payment?
Oh yeah, the scheduled end date. Ignore it. Don't pay any attention to that scheduled end date. When you use an income-driven repayment, it's meaningless, right? So they don't project whether or not you're going to reach forgiveness. Your scheduled end date is based on essentially you not renewing under pay as you earn and then continuing to pay your balance under a standard 10-year plan based on what your loan balance is at that time. That scheduled end date is meaningless from your loan servicer on the income-driven repayment side of things.
If you have the option to pay off a significant chunk or all of a higher interest rate loan before consolidation, would that be a worthwhile investment?
No, absolutely not. No, for the same reasons that we talked about earlier, you have better things that you can do with your money than pay extra towards your student loans at this point in your career, right? This is a webinar for interns residents, right? Interns residents are not making very much money, right? Do not try to pay off a higher interest rate loan just to maybe decrease your overall weighted average interest rate by 0.2%, right? You can do better things with that money during that advanced training, right? You will pay off your student loans using that income that you earn over the course of your career where you'll hit forgiveness, right? Don't try to force it now when your income is very low.
Along those same lines, what about when switching from pay to repay? Would it be best to pay off the interest first so it doesn't capitalize?
Yeah, I would not. And I would want to know more about why you're switching, right? So if I knew more about why you're switching and whether or not you were going to hit public service loan forgiveness or you're going to end up hitting, overall forgiveness using an income-driven repayment plan. But again, same reasoning applies there. If you're doing an internship or residency, you probably have some cash flow uncertainty right now, right? So you don't want to pay it towards your student loans, particularly when it's not required. Right. So save yourself the financial stress, let the capitalization hit happen if it makes sense for you to switch from that one plan to the other, and then, make the payments over time and either pay the balance to zero, hit public service loan forgiveness, or you'll hit forgiveness on the income driven repayment side of things.
If I change the loans over to repay before the anniversary date, will I have to submit my current income information before that date?
Yeah, so that's another good consideration and a great point, right? If you have a very low or no payment now, right, until January of 2024, then you don't want to switch repayment plans because they're going to make you provide some updated income documentation that will probably trigger a greater minimum monthly payment, right? So you may want to wait until you're due to renew again before switching.
I graduated in 2020 and have been in COVID forbearance since then. When I do the Pslf application paperwork, it lists 0 as qualifying payments made, but my payments have been $0 since I graduated. Shouldn't I have made monthly qualifying payments of $0 since graduation?
Oh, potentially, but it depends, right? So this gets into some of the complicating factors of graduating into the pandemic forbearance period. I'd really want to look at your loan portfolio. Have you chosen a repayment plan, right? A lot of the folks who graduated in 2020 because they graduated into the pandemic forbearance period didn't choose a repayment plan, right? Because they didn't have to, because there was no payments that were due, right? So if you didn't choose a repayment plan, then your grace period didn't end until 6 months after you graduated, and your public service loan forgiveness eligible payments couldn't have started until at least that time frame, right? Until after that grace period ended. Now, usually when we're not in a pandemic, your loans will automatically enter a standard 10-year plan payment after your grace period, right? So if you didn't choose one, it should have technically been put into a standard 10-year plan payment. Standard 10-year plan payments should be eligible for public service loan forgiveness. But again, if you didn't choose a repayment plan, it's hard to know if they're counting that as an eligible payment right now. Additionally, just as we illustrated with our example tonight, she has 2 years of public service loan forgiveness, but that was before the pandemic forbearance benefit went into effect. Now, the law states that time spent in an eligible plan and while working for an eligible employer during the pandemic forbearance period will count towards public service loan forgiveness. But I don't think that the loan servicers have actually officially counted that time yet. They're waiting until the pandemic forbearance benefit ends, and then they'll add that time to your account, because right now they're working through the backlog of all the people who have been in repayment for a decade or more to see if some of them have eclipsed the 10-year public service loan forgiveness threshold, right? So you may not be a priority for them right now, but once the pandemic forbearance period ends, submit that public service loan forgiveness employment certification form again, and you should get qualifying time starting from at least when your grace period ended. Or if you consolidated your loans and entered an income-driven repayment plan, it would have started from that time after your consolidation completed, if that overlapped when you started with your eligible employment, right? So again, another reason why you want to consolidate immediately after graduation is to get those loans into an eligible repayment plan, so they'll start to earn something like public service loan forgiveness credit earlier rather than after the grace period ends. So long-winded answer, probably need to look at your loan in greater detail. So post that on the student debt message board area, and we can walk through that.
Yeah. When filling out that application, why is there a box to find out qualifying payments and I believe I qualify for PSLF? Wouldn't you always want to check both boxes?
No, that's a great question. So I believe I qualify for public service loan forgiveness implies that you have eclipsed the 10 years of eligible payments already, right? That's going to trigger them to review your account for official discharge of your remaining loans. If you're just in the process of working towards that, then that's the first checkbox, right? I'm working in a public service loan forgiveness eligible employment capacity. Then they'll start counting your eligible public service loan forgiveness time. You don't want them to process the actual application for forgiveness until you know, or you think you have eclipsed the 120 monthly payments needed before they'll grant you forgiveness.
As someone who graduated over 10 years ago and is now in an extended repayment and going into an academic residency, I will not qualify for PSLF?
Not necessarily, right? So it depends. It depends on what your student loan balance remaining is. You definitely want to get that into an income-driven plan, right? Because that's a perfect example of why income-driven repayment can help you navigate that kind of career switch. You're probably taking a pay cut by doing that, which means even if you're using an extended or graduated plan, that payment's going to be too high, right? So have it based on whatever your new internship residency salary is going to be, which will be next to nothing using an income-driven repayment plan. If your employment or your experience is going to be eligible for public service loan forgiveness, and you still have enough student loan balance remaining where you could make 10 years of qualifying payments, then you could still hit public service loan forgiveness. It really depends.
What if I've been using pay past 2 years in an academic / 501c3 internships, starting an academic residency this year? Can I get the PSLF for the past 2 years, even though I've technically been on the pay plan?
Yeah, so yeah, and this is a good, we really need to spend some time on this one, right? So you have to be using pay as one of a plan like pay in order to be earning public service loan forgiveness credit, right? There is no public service loan forgiveness plan, right? It is a benefit that you will become eligible for once you meet all of the criteria. One of those criteria, as we have illustrated here, is they're using the right repayment plan, right? An income-driven plan is required to be meeting the public service loan forgiveness eligibility requirements, right? So if you're using a pay-as-you-earn plan, and by definition, you have to be making payments on a direct loan because pay-as-you-earn is only eligible for direct loans. The only other part of that is whether or not you're working for an eligible employer, right? And if you're doing your internship at an academic institution, then you need to submit that public service loan forgiveness employment certification form, right? And have that internship providing institution sign off on that during your time there, and they'll count that time that you spent at that internship as eligible public service loan forgiveness time. If you did a second internship at the same institution or another institution, you would do the same thing. Every organization that you work for needs to fill out one of these public service loan forgiveness certification form for you to start receiving that credit, right? That official credit that's actually logged in your file, right? So using pay is actually one of the requirements, right? Documenting that time is where the employer comes in, right? Because they have to sign off on when they consider your employment to be taking place there, right? There's a part on that form that you fill out. There's a part on that form that your employer fills out, right? And that's going to be what triggers this number, this count that's in your file. And once this count gets to 120, that's when you can apply to have the loans forgiven under public service loan forgiveness. Hopefully that clarifies that.
If you're not eligible for PSLF, don't have the 120 months of payments, but want to apply, should you wait to apply for PSLF until after the COVID forbearance ends?
No. So we have to differentiate this here, and let's maybe we need to pull this form up. So the form you use to certify your employment and the payments that you're making as public service loan forgiveness eligible is the same form you'll use when you apply for forgiveness, right? So this is what the person was asking about a couple of questions ago. I believe I qualify for forgiveness right now, right? You can only be eligible for forgiveness under public service loan forgiveness, under temporary expanded public service loan forgiveness, if you have met the 120 monthly qualifying payments, right? 10 years of qualifying payments, right? If you're not there yet, then you don't want to click that box, right? But if you believe that you're making qualifying payments, then you click that first one, right? Even if it's during the pandemic forbearance period, you want to get this submitted, especially if you have the employer portion filled out, right, and signed on your behalf. Submit that. They may not process it and reflect it in your file until the pandemic forbearance period ends, but I still want to have that form submitted to them. So once the pandemic forbearance period ends, I can see if they actually counted that appropriately. And if they didn't, I want to pull out that form and say, hey, I submitted this to you guys. How come you haven't processed it yet? Right? So submit this every year whenever you change employers, right? Because you want to have that documentation on hand. The farther away you get from those employers, the harder it's going to be to find somebody there to fill this out for you, right? So you want to do that ideally before you move on from that experience, right? But if not, hopefully you're not too far removed where you still know somebody there that can help you fill this out. Does that make sense?
Submit that documentation and keep a copy for yourself.
Yeah, absolutely. Yes, absolutely.
I already have a few years on pay. If I want to apply for PSLF now that I'm in a qualifying job, my loan servicer is not Fed loan servicing, would switching my loan servicer restart my time for IDR forgiveness if something happens and I don't end up getting PSLF in the future?
No, absolutely not. Switching loan servicers, switching repayment plans do not restart your clock. The only thing that can restart your clock is consolidation. And even that, I have to put a bunch of asterisks on now because of all of these special exceptions that we have in place through the end of the year, right? But I know that is a really common concern. There are very, very few instances where your clock gets restarted, and consolidation has to be involved for that to happen. Switching loan servicers doesn't do it. Switching repayment plans doesn't do it. But what can happen when your loan servicers switch? So again, you're not going to be able to switch loan servicers at this point. But when you submit, now that you're working for a public service loan forgiveness eligible employer, when you submit that form and they determine that you have PSLF qualifying payments, they're going to automatically move your loans. That's just part of the process. And right now they're going to transfer them to MOHELA, right? Because that's the official servicer for public service loan forgiveness. Right now, when they move your loans, mistakes get made, right? A lot of times, probably more often than not. They may not move your pay-as-you-earn plan over correctly, right? They may not move over the number of years you've been in repayment correctly, right? So you're going to want to watch that. It won't restart your clock. You want to know what the documentation is for your current loan servicer on hand, right? So you can identify a mistake if it gets made when your loans get moved to the new loan servicer, but it won't reset anything, right? You just have to have a way of proving what status your loans were in during the move if a mistake is made, right? And you're just going to have to watch that, right? I mean, mistakes get made. I had my loans moved and mistakes got made, right? They didn't move over the repayment plan appropriately. They capitalized my unpaid interest. That wasn't supposed to happen, right? You have to identify these things that happen when loans get moved from one servicer to another and get them undone, right? If you notice that happened.
Couple questions here about, do you submit that PSLF form at the start or end of a internship and residency?
I would say it probably makes the most sense to do it towards the end. However, I don't think it matters, right? I think that you're going to want to, probably because my guess is when they fill this out, especially during an internship, whoever's filling that out for you is probably going to put an end date in there, right? Because those internships and even residencies have pretty defined end dates, right? So they may fill that out for you, whether you do it in the beginning or you do it at the end, right? Whatever is going to work best for you to remember to do this, right, I would say do that, right? Now, you probably need to be in repayment before you should submit one of these. And that's important, particularly if you're just graduating and starting an internship, right? If you haven't consolidated your loans and you submit one of these forms and you happen to have your loan still be in their grace period while you submit this, well, they're going to say, well, you're not in an eligible repayment plan, right? So you have to be in repayment after you start that job for you to start receiving public service loan forgiveness eligible payments, right? So which is another case for you to consolidate your loans if you haven't started it already to get that grace period ended so you're in repayment shortly after your internship starts.
Can the NIH loan repayment program payments made to loans count toward PSLF?
Well, it won't count toward it. So that's a different kind of loan benefit, right? That's kind of like the veterinary medical loan repayment program. That's a payment that's made specifically towards your loans, right? So if you think about it, that's not just like the veterinary medical loan repayment program. That doesn't play well with public service loan forgiveness, right? Because if I have an outside party paying $25,000 towards my student loans, and they're ultimately going to end up being forgiven tax-free, well, that was kind of wasted, right? I would rather have had that $25,000 paid to me right? And I could have used it to satisfy the minimum monthly payments on my student loans, right? Or do other things with it, because ultimately the remainder of my balance is going to be forgiven. So that's not all that helpful, right? So sometimes some of these various loan repayment programs that are out there don't play nicely with each other. And you will have to be very careful. So when you have a large payment made towards your student loans like that, sometimes your loans will be put into a paid ahead status. The paid ahead status is an enemy of income driven repayment and public service loan forgiveness, because it does some really funky things to your anniversary date and your qualifying payments. So you have to be very careful when that type of thing is made. I mean, if you're in that position and they're going to make that payment towards your loan anyway, and there's no other way for you to receive it, take it, right? But you have to be very careful that it doesn't screw up your overall progress towards public service loan forgiveness by messing with the paid ahead status, or screwing with your annual income driven certification. If you have any more questions about that, that's another one we probably should dive deeper into in the message boards, because that's really a complicated scenario, right? But just know that, no, I mean, if somebody makes a $25,000 payment towards your student loans, that will count as one payment towards public service loan forgiveness. That's it, right? And then you have to make sure that it's not going to screw up future qualifying public service loan forgiveness payments.
Got a couple questions here. One that says, why would you recommend pay over repay while in residency? I'm not sure I understand.
Because it will give you the most flexibility to keep your payments at the very lowest level possible. It has a shorter maximum repayment period, which will reduce the amount of time and the amount of money that you pay towards your student loans if you hit forgiveness. And it will reduce your total repayment costs if you end up hitting forgiveness.
Now, what if you think you'll have a debt to income ratio less than 1, but haven't started your residency yet? Would you start and pay to have the flexibility while uncertain?
And again, that's the crystal ball, right? So I'm a probability person, right? So if you give that debt to income ratio less than 1 scenario a probability that's greater than 75%, then start with repay, right? Use repay, right? Because repay will give you the benefit of the unpaid interest subsidy, which will reduce the amount of interest that accrues. Presuming that residency projection where your debt to income ratio is going to be less than 1 pans out, you're going to pay your loans to zero before benefiting from any kind of forgiveness. So you want to reduce the amount of interest that accrues so you pay less towards your student loans. But as soon as, if you see that that's not going to pan out, if that probability calculation changes for any reason, right, then you want to switch to pay as fast as possible.
We have somebody here that says, if you were forcibly moved from FedLoan to Mohila, where do you get the documentation from FedLoan to make sure mistakes weren't made?
Well, if you can still log in to your Fed loan account, you can try to get them there. Your student aid data file will have a lot of that information in it, so you'll want to have that. So go to studentaid.gov. You can also reach out to the Federal Student Loan Ombudsman, it's called. So federal student loan, I type this in all the time because people ask questions like this all the time. But if you need access to that, they're supposed to transfer all of your history over to the new loan servicer as well. So you can reach out to Mohila and say, hey, can you send me a copy of all of the loan history that came over with my loans? And they should send you that. It may take them a while to send it to you. If they give you any flack about it, call the ombudsman and make that same request, right? So they're kind of the official loan referee, if you will. And if your loan servicer is not helping, or they're being unhelpful, or they're telling you things that are wrong, or just being belligerent, which they can also do, then call the ombudsman and they'll usually get you to a contact that can help you resolve that sort of thing.
Thought our student loan servicers were supposed to be the Chick-fil-A of service.
Yeah, not even close.
You're not from the South, Tony. I don't know that
Yeah.
you would understand that one.
Yeah, we have plenty of Chick-fil-A's here, but I'll tell you that whatever the service comparison is, student loan servicers are at the bottom of the barrel when it comes to customer service. So you're going to have to protect yourself.
Oh, that's great advice. That's really
Yeah.
great advice. When you start payments, is that when the clock starts? So when you consolidate, it groups the different loans together based on when you've started your payments?
It starts when you're officially in repayment, right? So once the consolidation completes, you will get well, normally when we're in repayment, you'll get a statement for a payment due 30 days from the completion of that consolidation, right? That's the official start of repayment. But since we're in the pandemic forbearance period, your official repayment is likely to start 30 days after the consolidation completes, right? Even though you have a $0 monthly payment. Now you should get, when you consolidate and you apply for an income driven repayment plan and you provide your income documentation and they generate a payment schedule, right? That they'll show you what your payment should be for the subsequent 12 months, right? Even though the pandemic forbearance benefits in place, you should get some confirmation documentation of a payment schedule for your income driven repayment plan that covers the first 12 months or the next 12 months of repayment. That's confirmation of the plan that you're in. But you'll also see, right, when you download your file and you upload it into the My Student Loans tool, you'll see a plan listed here. When you see a plan listed here, that's when you're in repayment, right? And in the guts of these files, there's actually a plan start date as well that they use to kind of calculate your anniversary date. So, we can see that information from that student aid data file if you have any questions about it.
My general thought was always that I should pay the least amount. I'm sorry. My general thought was always that I should at least pay the amount of interest that is accumulating monthly so my interest doesn't increase. But you're saying that if my payment is $0, I shouldn't pay anything. It's okay to let that interest increase.
Absolutely. Absolutely. Right. Because you can take that thought experiment to its conclusion, right? Let's say that you made interest only payments for the full 20 years under pay as you earn. What would happen? Right? You would have the principal forgiven, right? So you would still hit forgiveness. You paid more than you had to towards your student loans, but you still had to plan for forgiveness, right? So it doesn't make sense to pay more than your income requires. This also is shown in this simulation, right? This person has a balance of 237,000, 270 is forgiven, right? Which includes the interest that accrued, right? So there isn't any benefit. While it would reduce the amount that's forgiven, you'll end up voluntarily paying more than you have to towards your student loans if you hit forgiveness, right? So, and that's the value of running the simulations. Keep putting a lot of different permutations in here of what your income could be, particularly as you're getting closer to the end of your training. You should have a better understanding of what your income could be so you can start to refine your simulations. And you'll see if you keep hitting a forgiven balance here, then it never makes sense to pay more than the minimum, even if the interest is accruing, right? It's better to pay what your income requires, push as much of that into the forgiveness category as possible. And if you have to pay a tax, plan for the tax, right? Because that will give you the lowest repayment cost and keep the maximum amount of money in your budget during repayment.
And Tony, can you show one more time on the simulator here where you can put in that additional monthly contribution
Sure.
information?
Yeah, and that's in the advanced simulator setting. So let's just make up an amount. Let's say we're going to pay $500 extra a month in this simulation. For before I run simulation button, I want to see my total projected remaining costs are 266 here. Let's see what that does to my simulation. Right? If I paid extra, more than I had to towards my student loans, I have less forgiven, but I still hit forgiveness, right? And now my total cost just went up by $65,000, right? And that is because they went up basically by the $500 monthly payments for 15 years, right? I lowered the forgiveness, but I paid more than I had to. The forgiveness acts as a significant benefit if you're on track to hit it, right? So you don't want to do anything that's going to interrupt that, right? Even if I have to pay 40% in tax, it's still going to be a significant benefit, right? But there's a chance I may not have to pay anything in tax, depending on what Congress does with this current exemption that's in place, right? So again, there's really not a lot of good reason to pay more than your income requires towards your student loans, right? And if your income increases way higher than what we projected here, congratulations, right? Your payment will be 10% of whatever that way higher number is, right? It's still a really good way to pay your loans back without, hurting your budget.
Yeah, to oversimplify things, it's like you're getting a discount, but you're like, no, take this extra money too.
Yeah, exactly. Right, exactly. And you really don't, you really don't want to do that. Take full advantage of that discount.
Got a couple of final kind of financial wellness and planning questions here. As far as emergency fund, retirement fund, and planned forgiveness fund, what do you suggest for kinds of accounts, investments, banks? They've also mentioned that
Ooh.
adulting's hard, which I
Yeah,
appreciate.
adulting is hard. And let me come back to here. So yeah, emergency fund, online savings account, right? Go to Bankrate or NerdWallet, look for whoever's providing the highest yielding interest rate for an online savings account. You want to make that a dedicated account to your emergency fund, right? Don't put that in your spending account because that's just a slush fund, right? So put one layer of separation there, set up some automatic transfers. You want your emergency fund ideally to be 6 months of your expenses. Have that in a dedicated savings account, earning some interest. It's there. You can transfer it back into your spending account if you do have an emergency, if you need it. But that's the best kind of account for that. Retirement savings, we'd have to do another 2 hours on, right? So it really depends. When you have an employer-sponsored plan, like a 401k or a simple IRA, you want to take full advantage of that, right? Contribute at least whatever you need to get the maximum employer match if they offer one. Try to get 10%, if not 15% of your gross income into some kind of tax advantage retirement accounts. That could be a combination of them. Right. So if you don't have access to a 401k or a simple IRA or some kind of employer plan, then you can start your own, right? You can have a traditional IRA or a Roth IRA, right? So you can do those things now and build those funds. That you can open with any provider you're comfortable with, right? So Vanguard, Wealthfront even does those too. All of those same kind of providers that offer you some kind of low-cost index fund investing will offer some kind of retirement fund option as well. But sometimes if you're going to do it through your employer, you're going to have to use the one that your employer uses, right? So you might not have a choice there. But you can have a combination of those going simultaneously. And what was the forgiveness fund? So the forgiveness fund, I generally recommend, you can treat it like retirement, but don't use a retirement specific plan for your forgiveness savings, right? Use a dedicated taxable investment account. That's what my Wealthfront one is, right? It's a taxable investment account, not a non-retirement account that I have dedicated specifically for our forgiveness.
And if we do have extra money after directing to all of those other places, is it still a bad idea to pay off more of my loan early? Can I pay directly to the principal in that case? And this person did mention they're not likely to reach forgiveness based on running their simulation.
Yeah, if you're not, again, I can always come up with some other place that's better to put that extra money, right? Saving for the down payment on a home. If I've got some other investment ideas, like, starting a practice or a side gig or buying into a practice, I always want to have some extra cash flow available for those kinds of opportunities because you never know where they're going to come up. If you're starting or expanding your family, oh boy, it's expensive, right? You want to have some buffer built in. That's probably outside of what your emergency fund will cover, right? So, there's always other areas that are probably more appropriate that can benefit more than putting extra towards your student loans. But if you run out of places to put those things and you're not going to hit forgiveness, then sure, right? You can pay extra towards your student loans. I would target the higher interest rate loans first. You're not going to be able to put it directly towards the principal. I mean, unless you've already covered all of the interest that accrues each month, right? So just be a little bit careful there. There's no option for bypassing the interest and going directly to the principal. You have to make sure you've covered all of the interest first.
You actually kind of led into this next question here. Can we hear your comments about loan repayment and family planning? I deferred, and we were considering paying hard and fast to get a significant amount of loans paid down before having a little one.
Yeah, I guess, to me, I guess we took the opposite approach. I mean, there's nothing, your student loans aren't preventing you from doing anything. Starting a family, buying a home, buying a practice, doing anything you want to do financially. The only thing that prevents you from doing that is yourself or the plan that you choose, right? If you choose a plan that requires a significant monthly payment, well, that's going to put a pretty big dent in your cash flow, which means you may have to postpone starting a family, right? You don't have to do that, right? If your student loans are the big hang up, then don't let your student loans be the hang up, right? You can always peg your payment to 10% of your income to your student loans, which should free up enough to budget that family, right? So you don't, I mean, there's nothing that says I can't have student debt and a child simultaneously, right? So if anything, the income driven plans will make it easier for you to do those things simultaneously, because not more than 10% of my discretionary income is going to go towards my student loans. And as we've seen with the pandemic forbearance and all these recent announcements, there's all these additional goodies and expanded benefits and, again, reasons to not pay your student loans faster than your income or the plans require you to do so. So if you have other goals that you want to pursue them, right? Don't let your student loan stand in the way of that.
One last question here, and it's one that we see fairly commonly. They say it's a silly question, but we see this quite often. Say we do the pay and we are on track to forgiveness. The forgiveness is guaranteed as long as we have paid our dues, right? No last minute curveballs.
Yeah, I just don't, you'd have to tell me what the curveball is. I haven't seen any curveballs, right? If anything, I've just seen, softball lobs down the middle here, right? From somebody that's been looking at this for the last decade, it's amazing to me that more people don't use income-driven repayment plans, pay the minimum, and plan for the forgiveness. All of the horror stories that I read in the news of all the people that aren't able to do adulting or life things because of their student loans, I feel like they just haven't figured this out yet, right? Because as long as you have those federal student loans, you don't have to punish yourself, right? The rules, the laws, they're really clear. Now, they were very difficult to navigate in the past because there were multiple different loan types and the loan servicers were even worse than they are now. And, there was nearly no tracking mechanisms in place and hardly any information out there to help you, know the exact right things to do. But that has all changed, right? So there are no like, trap doors, right? That the law states the contract that I signed when we took out our student loans state that if I use revised pay as you earn and I make 25 years of monthly payments and I still have a balance remaining, that balance is forgiven. That's what the contract says. Now the question becomes whether or not that will be treated as taxable income. Right now, we have an example between now and 2025 where student loans specifically are exempt from being treated as taxable income when they're canceled. I don't know if that's going to be the case when my loans are forgiven, which is why I'm still planning for the tax on forgiveness. But I don't have any delusions that the tax or the forgiveness itself won't happen, right? The forgiveness is going to happen, right? That's what the contract says, that's what the law says. That's what every improvement is working towards, making it easier to know exactly where we are in the process. But I'm also counting that myself, right? So, there's a lot of things that are happening here that are going to make student loan forgiveness real and a lot easier for people to obtain. The thing that keeps me up at night is if you have to pay the tax that you're not prepared for it, right? I don't want to see anybody having to raid retirement accounts or sell their home, or, not send their kids to college because they didn't plan for the $100,000 tax bill that they may have to pay, right? If you're using this time to your advantage, at least after you're done with your training, to start saving for that forgiveness, then you should be just fine when it comes to covering that tax if you have to pay it.
Yeah, and I think, these changes that we've seen recently with the FEL loans, I mean, that just really goes to show how they've been trying to make these programs more and more beneficial for people that, they may have not been beneficial before.
Right. I mean, it's crazy. They for people who've been making payments on their loans for 20 or 25 years, even the person who said that they've been using extended graduated plans, they're actually, some of these new improvements are going to treat the time you've been making payments on extended and graduating plans as if they were income driven plan payments. I mean, that's crazy, right? I mean, that is like, they literally just threw out all of the rules and said, however you are paying your student loans, we're going to count it towards forgiveness. Right. So, I mean, we're
Yeah.
really to the point now where it's like anything goes if we can just get your loans forgiven. Right. It's kind of nuts. Right. They don't want to just come out and wipe out everybody's student loans. Right. But they're doing everything they can to say, well, how long have you been making payments? If it's been 20 or 25 years, we're calling it good. Right. Which is kind of how the forgiveness plans probably should have been set up in the first place, but they weren't.
Yeah.
Right. So, better late than never, and it's going to be extremely confusing for those people that have been in repayment for a long time. But if you start out of the gate, as we've been talking about tonight, you can reduce the risk of any of that, craziness applying to you.
All right. And we had somebody sneak one last question in here. You mentioned published information about starting salaries for specialists. Is this through AVMA?
No, actually not. So the ACVIM one is in the journal for ACVIM. I believe I saw the surgeon data published in the journal for the surgeons. There's very scant data. The data the AVMA has kind of captures specialists in aggregate as part of their general salary surveys, right? So there's usually not appreciable numbers in there, and they don't really go to the level of breaking them out per specialty, right? But the specialty colleges, they should be doing that, right? And I think a lot of them are doing surveys and things, but to the extent that they actually publish them is a different story, right? So we are seeing some people, Sam Morello, and I think she's at Cornell now, or I forget where she is now. She was at Wisconsin. I believe she's at Cornell, but she's the one that's done the surveys for the internal medicine specialists and the surgeons recently, which is great, right? Because that represents a good chunk of the specialties, but there's still a lot of other ones that we don't have a lot of good data for. I've seen some random surveys that some of the members of those specific groups have access to, that like outside groups have done for like the pathologists, for toxicologists. I mean, that's not generally public information though, right? So I can't just share that, right? But if you ask, if you're a member of one of those, or if you're a resident in one of those specific specialties, you should be able to request those from your whoever the leadership are in those organizations, and they can provide those to you, or try to spearhead a survey of your own, right? I mean, I think that that would be really helpful in trying to create a regular source of this data, right? Because it's weird. Even the ones that Dr. Morello has done recently, I think the data for the surgeons was from 2017, and the data for the internal medicine specialists were for 2020. I mean, that stuff's already outdated, right? I mean, it needs to be done again, right? So it needs to be done on an annual basis, and the best groups to do that are probably the specialty colleges themselves.
All right, that's it.
Great. Well,
Success.
thank you. Yeah, great. Thanks for all the questions, and for those of you that stuck it out, and we covered a lot of great information. There was a lot of great questions. The recording will be available, and we'll make the slides and everything available too, so you can click through the ones that we didn't get to. But yeah, keep asking questions. Take advantage of all those resources we talked about. Use the Student Debt Center and the Student Debt Message Board area, and don't suffer in silence here, right? There's a lot of collective knowledge on what to do and what not to do with your student loans. Make sure you're taking full advantage of that.
All right, sounds good. And it looks like our pre-veterinary student is one who stuck it out to the end. Good
Wow, holy
job.
cow. Hopefully we didn't scare you away, right? We do a whole different presentation for pre-veterinary students. We'll be doing that later this summer or early fall to correspond when the VIMcast closes. But yeah, hopefully we didn't scare you too much. But yeah, student debt's a real concern and a real stressor in veterinary medicine. So, but thankfully we've got some good, gold standard practices to give you guys if you're willing and able to listen. So.
All right. Well, thank you, everyone. Thank you, Tony, for all this great information, and to Jordan and Charnette for helping with the Q&A and keeping things running. And you guys have a wonderful evening.
Yeah, and thank you too, Becker, for facilitating and monitoring the Q&A. So thank you, everyone.